Welcome to Launchpad. How many people is your first time here at the Launchpad? Okay, great. All these lovely dressed people that we have here. Thank you for coming. I'm John Hannon, founding director of the Brooke T. Smith Launchpad. Been here 10 years and heavily involved in running entrepreneurship here at Clemson. Just want to give out a few quick thank yous. First of all, I work in the president's office for the president and Max Allen, who's his chief of staff. And so this is a picture of Jim Clements. Most places you go, you'll see the headshot. But I took this picture as a spy at the softball field. And Jim Clements got out of his seat. He was there with his daughter, Grace, walked up the stairs, walked to the back of the line, and at the concession stand. He doesn't own this place, but he runs a lot of it. He theoretically could have had somebody bring him food. He could have had a side door that he went to get food that was already ready for him, but he got in line just like everybody else. And so that's the Jim Clements that I'm very fond of. Next up is Max Allen. Max is my boss. He's a tremendous support to President Clements day in and day out. And so we're grateful for them. Just want to give a shout out quickly to our staff here. In the upper left-hand side is Maggie. And I don't know where she is right now, but she's solving a problem somewhere. We call her Maggie to the rescue. That's her middle name, to the rescue. Michelle is here. Where's Michelle? Give a wave in the back. And so we also have Susan is actually off sick today, unfortunately. Liam is off sick. But Kimberly has been very instrumental in putting this program together for us. She's been the point person, so we're grateful to her. That being said, I'm going to turn the microphone over to our co-chairs. These two guys have helped me for the better part of 10 years, and I'm very grateful to them. And there are MCs and our chairs for the day. They have invested 40, 50 hours, 60 hours into this for various meetings, all volunteer, and we're just super grateful for them. So that being said, have a great day. I'm here, Michelle is here, Maggie's here, any of us are here to help you, and Kimberly as well. So we're gonna churn through this pretty quick today. That's it. Thank you very much for coming.
Well, first of all, welcome everybody. Hopefully this will be a fun Friday afternoon for you here in Clemson. I'm a 1990 Clemson grad. Matt has loved Clemson so much he graduated twice. So anytime it's opportunity to come back to Clemson Friday for a football weekend, we're all in. So we just wanted to level set with you all, take a couple minutes, talk about what we're going to talk about today. It's really, we're calling the Capital Allocators Symposium, the first of many that we will be conducting over the next several years. This has been a goal of Dr. Hannon's for a number of years to get this community in a room together to impart hopefully some wisdom upon the students who are interested in the careers in the private capital markets, which is really how we think about the capital allocators definition. So Matt and I are your MCs for the afternoon. Hopefully we'll keep things moving along swiftly, but we really wanted to just talk about what we're hoping to accomplish today and beyond. First goal we had in mind was just getting the professionals that are here today for this symposium together in a room to get to know each other better. We're all Clemson connected somehow, and create better connections amongst ourselves, create business opportunities amongst our firms, but just create that network effect within our industries such that we can be able to offer better outcomes for the students here at Clemson. And second, but probably more important, is to develop this forum for you all to learn about the industries, hopefully be inspired to consider careers somewhere, somehow within these industries, and ultimately having us help you get into this industry some way, someday. So creating this education is kind of the first step, and then following up with how do we create it, make it easier for you sitting here in Clemson, South Carolina, to get into one of these industries over the course of your careers. Like, where do you start? How do you get into it? What does it look like when you're in this industry? So this is kind of a quick overview of what we're going to cover today. I think you guys have seen this, but we're going to start off with the venture capital session, private equity, and then the private credit and what we're calling other alternatives. Then we'll do a session with a number of our symposium attendees talking about their career journeys in these industries. And then we've got a networking session here at the end. Big shout out to Joe Alala and Capitala for sponsoring that. So upping our game here with the refreshments at the end of the day. So hopefully we'll keep this moving quickly. And I will let Matt give you his intro and his story.
Yes. Hello, everyone. Just jumping off of what Peter said, I think kind of just to drill down on one of our big goals today is like, if you guys are anything like me, when I was a student at Clemson University, I knew like almost zero about venture capital, about how to fund a company. I knew about as much about that as I did about like microbiology, which is also zero. So, what we want to do is to equip you with just a little bit of understanding of how to fund a company, how to fund it through its different stages as well, from like the very germ of the idea all the way up to like, oh my, we actually might want to sell this company and exit and make a ton of money, right? So that would be awesome. And a lot of the panelists that we're going to have today have gone through that path. So I would just encourage you to lean in and listen to their stories. Go up to them afterwards and ask them questions like in the forum, because if you've got a question in your head, I bet you like 10, 15 other people have the same question. So lean in. These are all guys and girls that have been through it and have, probably traveled the path that you're interested in traveling. But I guess for me, I'll just do the very quick version of this, hopefully, but I got about a 30-year career. I just kind of call myself a good athlete in business. I've raised a bunch of money. I've bought companies and sold companies. I've been on boards. I've been a CEO 3 times. And these days, I basically coach CEOs. So my firm, we coach some of the highlight best CEOs on the planet from all over the world in all sorts of different industries, including like Allo Yoga, Naval Ravikant, Sam Altman is part of our group. So what we do is today we watch how these best CEOs on the planet run their businesses and raise money, and we like steal their ideas and share it with other people in terms of helping other CEOs like build their companies and raise money. So yeah, that's my story. Peter, you have one that's almost as interesting.
Not nearly as interesting. Well, so Peter Markham graduated 1990, marketing degree from Clemson. Today, I'm a senior advisor for a firm called Silver Point Capital. It's a firm I've worked in a couple of different iterations over the last 20 years. Silver Point is a $40 billion asset manager that invests predominantly in credit, both public credit and private credit. Half of our business is in the private side, which is where I spend most of my day, with about 16 billion of that in our direct lending strategy. So simplistically, we're doing loans to companies that need capital, whether that's for M&A, doing an LBO, refinancing an existing part of their capital structure, or some company that's sort of in distress and needs capital to kind of clean up their balance sheet. We've, private credit is a business segment that has become incredibly popular. When I started in it in 2006, we didn't call it private credit. It was just hedge fund direct lending. It's evolved pretty massively, and it's a huge asset class. How did I get here? After I left Clemson as a marketing major, I went into marketing, started my career in, first job was at a consumer electronics company in consumer marketing. So did that, which took me to New York. And then for the next 5 years, kind of bounced around in some media, technology industries from marketing and sales perspective. Got involved in corporate development at one of those firms, which is essentially on the corporate side, you're the person helping a company grow through M&A or raising capital. And that's how I got introduced to investment banking. Knew nothing about it, probably less than Matt knew when he was here. I was like marketing major, sounds like a cool industry. sort of totally changed my perspective when I started looking at doing deals. I went back and got my MBA at NYU to make that pivot. I felt it was necessary to get into the industry, to have that credential at the time. And from there, I spent 10 years in investment banking in New York at a firm that was a specialist firm that all we did was media, telecom, tech. We were doing M&A as well as raising capital for companies, predominantly private equity, and then evolved into raising private debt. We started what we call our private capital group, which is really what got me into the private capital industry. From there, I got recruited by this firm, Silver Point Capital, to come lead their efforts in the TMT sectors for their new direct lending business. That was 2006, and fast forward to 2010, we had made a bunch of investments. The global financial crisis had happened. Some of these companies wobbled, couldn't support their balance sheets. So we had to restructure those businesses. So I was inside Silver Point doing the restructurings and had the opportunity to take two of those businesses and become the CEO. First time CEO, didn't know what I was doing, but I knew the industry, I knew the situation, and it was an opportunity for me to sort of take a big leap in my career and try. Very successful at those, restructuring those businesses, sold those businesses off over 5 years. And that's what I've been doing for the past 15 years, is taking businesses that are predominantly owned by private credit firms as a result of a restructuring that need to be restructured organizationally as well as revitalized as a business going concern. So very different than what I thought I'd be doing when I left here in 1990. So hopefully an indication of, I don't know what your current career aspirations are, or what your majors are, but most of the people in this room didn't start at Clemson majoring in private equity. There's no such thing. There's many paths into this industry, which is, I think, one of the things we really want to impart upon you all the rest of this day and going forward. And just really quickly, because we're going to dive into this much deeper in the later sessions, just what is the private capital industry? U.S. market size is about anywhere from 10 to 12 trillion, depending upon how people measure it. Just to give you context, the GDP of the United States is 29 trillion. So it's an enormous industry in private capital markets. Really made up of venture capital. I think something that gets a lot of headlines in terms of businesses being startup. That's why we're at the launch pad, which is really the goal of this place, is to encourage students to think about having a startup and getting funded. That's about a $1.3 to $1.5 trillion industry in the United States. Private equity, sort of traditional leverage buyouts, buying companies, good companies that are growing, companies that need to get restructured and need to fix their balance sheet and have an injection of capital. That is a huge industry in the United States, $4.5 to $5 trillion. And then the private credit industry has grown to about $2 trillion today. From when I started in it in 2006, it was like a couple $100 million a year. So grown massively, super important asset class. And then the other alternatives that kind of fit under that: real estate, infrastructure, which is today dominated in the headlines, at least, by the digital infrastructure. So look at Meta doing this $30 billion JV with Blue Owl to fund the future of their AI data centers and things like that. And then the asset-backed, asset-based industry, which is this sort of niche corner of the market, funding all kinds of things that impact your life every day, like consumer credit, auto loans, et cetera. And then the secondaries market, which is sort of this market of trading all these assets after somebody makes an investment, and limited partners want to get out of those investments, but there's not an exit window to get out. So there's firms set up. We've got a partner from one of those firms in the room who does that every day. So hopefully we'll impart some knowledge about that space. So that's really what we're going to talk about today. So hopefully you guys will have a lot of fun, ask a lot of questions, and let's get going.
Just by show of hands, like, who's got like maybe an aspiration to one day start a company and raise money somehow via venture capital, seed fund, angels? So we're going to talk about that. And then who, just show of hands, might want to be interested in getting involved in the venture capital space, like with a firm, like working for a venture capital firm. Good. All right. Kind of the same hands. All right. Well, I'm going to take just like the first 2 minutes, maybe 3 minutes. Put me on the clock, guys. And we're going to talk about we're going to do like the Chat GPT. What is venture capital? Real quick. Okay. Just for anyone who's maybe just starting in it. So, okay, here you are. You want to start a company, right? You've got a great idea. You've got some software you've built, something like that, and you're ready to start a company, and you need some money, all right, to build out the thing, to see if there's a market for it, to go into talk to customers, that sort of thing. So one of your options to get money for your company is to contact a venture capital firm. So venture capital firms exist. They will go out and look for opportunities to invest in startup companies. And the trade that happens is company gives up part ownership in their company for the money that the venture capital firm is going to give them. All right? So that's the trade. I now own part of your company. And now you've got working capital to start your thing, right? Now, where do venture capital firms get money? They get money from investors. So over here, you've got high net worth individuals, maybe business people who have sold their companies, maybe family offices, or sometimes university endowments will invest in venture capital companies. So venture capital firms will raise a fund from all of these investors over here and then reinvest that money into your startup business over here. Now, the goal for this whole, how everybody wins, is that you are successful in starting your company, you get a lot of revenue going, and you sell your company. You go IPO, you sell it to a big company, maybe a private equity firm comes and buys your company. So when that happens, everybody wins. The venture capital firm gets their return back, and they return their money to their investors. So that's how this whole thing works, right? So, so let's start here. We're going to turn it over to our all-star panel. So I'm going to introduce them along the way. So we've got a real live venture capitalist on the stage here in Matt Dunbar. So we wanted to ask you just to start and talk about just, yeah, what's it like to be a venture capitalist right now, today, and a little bit about your firm and kind of just how are you describing the ecosystem that I just described here?
Sure. Thanks, Matt, and good afternoon, everybody. Always a treat to get to come back to campus and especially to have a chance to talk with students. So thank you guys for coming out on a Friday afternoon, and here's hoping things go a little bit better in the Valley tomorrow than it has so far this season. So right now, the venture capital business is in a bit of a challenging part of a cycle. You're probably familiar with business cycles. And when I started in the venture capital business by happenstance, which we can come back and talk about that story in a few minutes, but I started in 2008. You guys may have heard about this financial crisis that happened in 2008 and how that shifted capital markets a bit. One of the things that happened as a result of that crisis was we got into a very low interest rate environment. And what that meant was that capital started to flow pretty freely for the next decade and a half. And so it was relatively easy for funds of various types to go out and raise capital from, call it 2010 to 2022. If you were paying attention in 22, the Fed started hiking rates at a pretty aggressive clip. And that has the opposite effect on capital markets, where now capital becomes much tighter for lots of reasons. And that really changes the dynamic in terms of how easy or hard it is for those venture capitalists or other funds to raise capital. And it also makes it more challenging to generate liquidity to pay back investors because fewer companies are buying and driving M&A activity in that market. So to answer your question directly, the last 2 or 3 years has been the toughest part of the venture capital cycle that our firm has had to live through because we started right after the previous financial crisis. So we've had to navigate a lot of challenges with our portfolio companies who maybe for a long time had been conditioned that raising capital is pretty easy And then that changed pretty quickly overnight. So we've spent a lot of time in the trenches with our companies, helping them think about their business models. Where can they conserve cash? How can we find ways to get them to cash flow positive rather than sort of relying on venture capitalists to fund their burn rate as they're trying to grow really fast? So a lot of interesting experiences to have in this new part of the cycle that we've had to live through. Fortunately, we've weathered the storm pretty well with most of our companies, although we've had some casualties. So one thing that hopefully you're aware of, but if not, you should know that the venture capital business is a very, very risky business because the base rate for startups is that most of them fail. And so you kind of have to know that going in, whether you're an investor and a limited partner who's putting capital to work in this business, or you're a general partner who's making the decisions on how those dollars get allocated. You have to think about it from a portfolio perspective because inevitably you're going to have quite a few failures in your portfolio in the venture business. So you have to learn how to be resilient and how to proceed in the face of a lot of challenges because that's just the nature of the game, but that's part of also what makes it fun. So I'll pause there. Hopefully that answers.
One follow-up for you, Matt. Go a little deeper on like the failure and success rate across your portfolio. So you make, let's say, 10 investments. How many of those companies are going to make it? How many are just going to you're going to zero out?
Yeah. So sort of the classic metrics that you think about in venture are that basically 10% of the investments are really what drive all the returns to the portfolio. It's a power law distribution typically in a venture capital portfolio, meaning that you have one or two companies in a fund of say 15 to 20 that are really going to be outsized returns that are going to generate most of the returns for the fund. You'll probably have another 2 or 3 or 4 or 5 that return maybe low single-digit multiples of the capital that you invested, and then the rest are going to be 0 or certainly less than 1 times the return on your money. So again, it's a very skewed distribution in a venture portfolio, and so you have to place bets such that if you connect with the pitch, you can hit it out of the park. So if you're thinking about raising capital as an entrepreneur, you need to understand that portfolio math from the perspective of the venture investor who, while your business idea might be good, in order to get them to write you a check, it's got to be great, and it's got to have the potential to be an absolute grand slam home run because, again, we know the failure rate's going to be high, so we can't really afford to put maybe 1.5x to 2x type return company in the portfolio when I need to be swinging for the fences to hit 10x type pitches. So understanding that dynamic when you're raising money from institutional capital is a really important part of your job as an entrepreneur.
Yeah, so just, I want to double click on that for a second because I think a lot, when I talk to entrepreneurs who are looking to raise money, sometimes I get the sense that they look at raising the round as almost a finish line. Like, oh gosh, I made it, we raised the capital. But what Matt's telling you is that's barely the start line. You've made it to the start line if you're able to convince a VC fund to invest in your company, because that's kind of when the hard work really starts. Because as he said, every single one of those 10 that he talked about that he invested in, they all had good ideas. They all were really dedicated and passionate, and one of them made it. So it's the start line when you get to the raising capital point. So.
And maybe just one quick follow-up to that, and some of you guys who have raised money and grown companies can speak to it, but when you take outside capital, that completely changes the dynamic of you as an owner in the company. You're not just working for yourself anymore. You now have a fiduciary obligation to these investors who own part of your business and probably have put in place a board that you answer to. And ultimately, if they don't like the job you're doing, it's possible that they would fire you. And so, again, another part of your homework as an entrepreneur is to understand that dynamic and decide, do I want to take outside capital, or should I bootstrap or find some other way to fund my company? So.
Yeah. Doug, I want to turn it over to you. You're on the other side of this. So you were an entrepreneur who raised capital. So
I've been a very good customer of the VCs. I've started just adding my latest one, be my 9th company that we started. The first one I did as a .comer in 1999 when the internet was brand new. Very much was to reflect your earlier comments. I was 27, 28 years old, raised $35 million to start a business that was me and 3 buddies. So all my friends started immediately calling and congratulating, wow, you did it. And to your point, all I did was take on years worth of work to put that capital to work and make sure that those investors that were willing to trust a 20-year-old kid with their hard-earned money got a good return. And I think it's a good point that point in the journey is a validation that you've got a chance, you've got an idea, you've got an opportunity, but you've also taken on a hell of an obligation to make sure you do everything you can to get those investors a return, to continue to justify their respect and investment. And like you said, if things don't go well, you can be fired from your own company. I never had to live through that, but a lot of my friends have. And I would say in terms of a couple just practical points around raising venture capital, if you're going to start on that track, I would say build a map of maybe the 10 VCs that you'd love to have a chance to pitch, and put at the bottom of the list the one you'd really like to get the money from, and pitch them last. Because the first 9 out of the 10 that you do are going to teach you how to answer all those 48 different questions you're going to get when you're on the hot seat doing that pitch, right? So it's just like a lot of other things in life. Reps count, get practice, and you don't want to be doing practice when you really want to be in primetime form in front of your best possible investor. And I got that advice on the early start. We went to Austin and pitched 5 VCs, and I thought it was the greatest thing ever, and they just shredded us because we'd never been up there before doing that dance, right? And by the time we got to New York, we were in our 15th edition of that show, and we knew the answer to every question they asked. Why? Because we weren't that smart. We'd done the reps, we'd been asked the question before, we'd done the research, we knew how to respond to it, and we knew how to nail that pitch and raise that money. So, start with the end in mind, get the reps, do the practice, and and be very methodical about how you go about that raise. It's really, really important. And I would never have, had I not had a partner tell me that, I would have went right for the one I wanted the money from right out of the gate, and probably never raised any funding.
Doug, I want to ask you a follow-up, and Matt, I want you to jump in if you have this experience as well. But we talked with Matt about the ratios, about how 1 in 10 of his companies makes it. Let's talk about the other end. Like, how many times do you really how many pitches do you have to do to get to the point where you're raising money? Because I've heard numbers, I've seen numbers where on the 100th meeting, you're able to raise the money. And I think that one thing I want to stress is like, just raising the money is like an endurance sport sometimes, right? So like, Matt, what was your experience there? And Doug, what was your experience there too? So either one of you take it away.
Sure. Hello, everybody. Thanks for coming and looking forward to our time together. So around the endurance sport piece, that was great advice. And the 10th one is the one that you want. Don't tell the first 9, by the way, that they're just working up to the 10th. But because you have to learn that language. And I'll tell you, I got some gray hair here, but when I first started doing travel, I was a farm boy. I didn't get on a plane until I was in my 20s. But at that time in the world, when you went to a foreign country, they didn't speak English, and so you had to learn some phrases. They didn't use your money, so you had to bring something called a traveler's check. You couldn't put your debit card in the ATM and all the local currency. You had to prepare in order to even just be there for a little while, right? So think about that. They have their own culture. And this is another country. There's its own culture, its own language. We already started to use some of that language subconsciously up here for people who may not know those words. So with that as a backdrop, this whole endurance sport, right? You don't just get parachuted in the company or into the foreign country with no prep. You got to learn. You got to adapt. You got to create relationships and live with the people there for a little while before you can say it. So that's the way to look at the endurance thing: is expect on your first day in the foreign country, if you find the bathroom, you've won. Like, that's your goal, to learn how to say that. And then as you live there for a little longer, you can sort of take those higher things. But it is going to take experience and learning. And then the whole idea is, if you become a serial entrepreneur, you'll get there real quick because you already know the language, you already know how to position it. Or if someday, you want to live in that country, that's to become somebody part of the capital stack here, so to become a capital allocator. That's what you're really signing up for, which can be a fun, that foreign country is fun if you're visiting or living there. So it's the way to look at that serial endurance need to be successful.
For my first one, it was lucky 13. So I have no fear of the 13 anymore. It's all good. No, it was an endurance race. I mean, it was over and over and over. And I'd say the other key thing is find a translator, to use the language analogy. I was fortunate to find a mentor that, had left NASA with a bunch of his buddies and started a company and got venture funding and then took it public and then sold it to Xerox and had an exit and was willing to stop in the middle of all that and make sure I could be successful. So, think about folks in your life, in your relationships, friends of yours, friends of your parents. It's a big part of this Launchpad function is to connect you with people that have done this for a living. And it can be a guide into that new country and learn that new language, figure out how to speak it, figure out how to pitch it, and understand who to connect with to find those resources. Because, no one does it alone. The stories you've all heard about the overnight success or the lone entrepreneur banging away at the laptop at 3 a.m. that somehow makes all this happen. That's a big part of it, but there's a big cast of characters behind every success, and finding those cast of characters and those supporters and those mentors and teachers that can help you on that journey is certainly one of the most important determinants of whether you'll be successful or not.
Yeah, and I would say one thing I want to add to what the gold from you just heard from those two there is they both use the word relationship in different parts of their stories. And if you want to know the number one way to get a real meeting with a venture capitalist who can make a decision about investing in your startup, in your possible company, is to figure out a relationship path to get directly to that person. And it could be, your dad or your mom's connections on LinkedIn. It could be a colleague. It could be a friend. And there's only one other way to get into a meeting like that, and that's a cold email, and that one's way down the list. So like Matt could probably tell you how many cold emails he responds to, versus if you compare it to, oh, like I got a friend and like he's really smart and motivated and he's got this great idea. Like those are the meetings you're gonna take, right? So is fact check true on that?
Absolutely. As you may not be surprised to know that there are a lot of people looking for capital. And so anyone who hangs a shingle that says we want to provide capital is going to have a lot of inbound demand, whether they like it or not. And there's only so many hours in the day. And so your point is exactly right, that because we don't have unlimited time, we're going to have to prioritize spending time on the things that we think have the most likelihood of fitting our parameters. And so a warm introduction from a trusted source is immediately going to move to the top of the box versus the things that come in cold. We do have a process to respond to those, but the probability of success with that approach is much, much lower.
David, I want to bring you into this and to talk. We're going to ask you to inspire our students because you've been involved in over your career in a lot of situations where you've been the bridge between ideas and technology and IP that comes directly out of a university and has been developed maybe even in an undergrad environment, being able to bridge that into a fundable company, into a company that sort of can raise money and can get into operational mode. So inspire us.
Wow. It's great to be here, John. Thanks for letting me be a part of it. And it's always the students that participate in these, it's always so fulfilling to be able to do that. I'm the utility player up on this panel, I think. I've worn most operator hats: CTO, CSO, CEO, COO. I've been chief legal counsel. I've been outside legal counsel. So I've worn a lot of different operator hats. I've founded probably around a dozen or been on co-founding teams that have had that. They've had things that have failed, and we've had things that have gone public in those founding teams. So those journeys, I've invested my own money and I've invested other people's money. I've run venture studios. And so in the ecosystem, I've worn a number of different hats. And what that has allowed me to do when it comes to university type technologies, like Matt was saying, is that really early stage where ideas are still sort of either getting ready to sort of spiral up or potentially go somewhere else. I can sort of help those founding teams figure out what they should do and how they should do it and where they should do it and what's fundable and what's not. And you mentioned IP, certainly super important. And, you know, Curve is a facility here or a resource here that you have for some of your ideas and other ideas that are going to germinate with you. You're going to have to be more on your own because they're not university based ideas. But I would suggest to you that the idea is awesome, but ideas don't make businesses. The technology has to be awesome, but technology doesn't actually make businesses. What makes businesses are fundable business models that will lead to sales. I used to tell people whenever they would come onto the team, I would tell them there's only two positions in this company: sales and everybody that works for sales. And I'm the CEO and I work for sales, right? You have to have something that's able to be sold. Otherwise, it's not going to be fundable. And yeah, that's just the key. So think about problem and buyer fit. I don't know if that was answering exactly what you wanted, but.
Yeah, and if I were to sort of jump off the sales thing, again, like when I talk to a lot of early stage companies, and, you know, they're in some sort of maybe dilemma of like, when should I go raise money? Like, when should I go speak to a Matt and see if my idea is fundable? And I would say almost 100% of the time, my advice to them is like, well, just go prove that someone will buy it. If you can go out there and prove to Matt that someone will give you money for the thing that you've invented or that your idea, market validation, you know, we have, you know, the starting a product market fit to, is like, if you show up to Matt's doorstep with that in hand, like, oh yeah, like 5 people have already bought my thing or subscribed to my thing, you're going to be way better chance that he will entertain a meeting and maybe write you, right?
And if I could just say one comment on the previous question to sort of beat that drum a little bit. And I've never had a problem with this with the Clemson students, the interns I've had. Like, you're all awesome at doing this. You have to reach your hand out. This business is full contact. It's not done in some space that doesn't include a handshake, doesn't include, if I had $1 for every person who's invested in something that I've done, who said, I will never invest in anything when I haven't had at least 3 meals with them. You just have to be able to start creating those relationships. And I feel like I have had maybe 70, 80% success. When there is a shepherded introduction, like Matt was saying, I'm the best batter on the floor, right? Because it's been teed up. But the number of times that I've been successful in, you know, something that's needed, where I am simply trying a cold process to get up to whoever I think that might be, it's handfuls, meaning it's just hard. So make connections. That's what these types of events are for. And you've got a great platform. John's opportunities that he creates here are great platforms to do that. So,
yeah, I think to build on that a little bit, back to the sales and customer point too, like, don't look past the opportunity, not just to make that sale, but to partner with those early adoption customers to actually, in effect, provide you your funding. The cheapest capital you can get is revenue, right? So if people are willing to, you know, and there are customers who will pay you along the way, even before you have a finished product. If they buy into your vision, they trust you enough, they have a relationship, and to have some of that, not only the sales, I totally agree with those earlier comments, but I would tell you, we've started more than one company with what I call customer capital, where people said, yeah, I really need that. I believe you can deliver it for me, and I'll pay you for it now, and essentially pay you to build it. And the reason that's the cheapest capital is because you don't have to pay any of that back. You earned it, right? There's no investor looking for it. They don't get a board seat. They don't have constraints. They don't dilute your equity. They just help you get launched. And if you can find those, it's a really magical way to start. It doesn't always happen, doesn't always work, but don't look past the opportunity for a customer to be that excited about what you can do for them that they will actually help you start the company through that mechanism.
And if they become those investors, those are
Yeah.
the best investors because they want what you're building. And so they're motivated to stick with you when you're struggling to get it built. Somebody who's just in it for the capital might not be that way, but those types of investors, that's exactly who they are.
Maybe I'll jump in with a comment there. Just given that dynamic that you just described, which I think is a brilliant strategy and your comments hold true. For a lot of you thinking about what you want to do after school, you might think, I need to go take the plunge to be an entrepreneur as soon as I graduate, which can be great. And I don't want to discourage that, but to identify the opportunities, to know where there's a problem that needs to be solved and have the relationships with a customer that might be willing to pay for the solution to that problem, it's to your advantage to have some industry experience. And so I wouldn't put too much pressure on yourself to think, oh, I need to start this company as soon as I leave school. If you have a great idea and you've got some insight, that's great. But don't be scared to go out and work in an industry that you find intriguing. Once you've spent some time learning about that business and that industry, you'll start to identify opportunities where things could be improved. And from that tend to come the strongest startups we see, where they're born out of someone's lived experience, feeling the need to solve a problem in an industry or in a business. That's where some of the greatest startup ideas come from. So maybe just a word of encouragement. If you're not sure about what you want to do to make the transition into entrepreneurship, going and working for a tech company or in an industry that you find exciting or intriguing can be a great way to help you start to identify opportunities and position you to launch a company sometime after you've gotten some experience.
I want to hop quickly to this concept of how different waves happen in what kind of companies are investable from like a venture perspective, and certainly from an entrepreneur's perspective, understanding kind of what's hot is sometimes a way to kind of more easily get down the path to raising capital. And right now, like I work with a lot of CEOs and a lot of venture firms out of the valley, out of Silicon Valley, and like there's a funny saying right now that's like, if you can spell AI, raise a $50 million seed round. But I want to get some commentary from you guys just about like this AI wave that we're seeing right now, and what your take is on it, and is there a bubble? Is it real? Like, give us your thoughts on AI.
Let me begin by my foreign country analogy. AI is the popular band, so they're all listening to AI. It's permeated that culture, and like you said, I know a VC who said, if they don't have such and such a description of the AI strategy, we're not even looking at them as a first time. Like that's now a criteria for their fund, and it's not an AI fund. It's literally kind of over here, but that's how permeated that culture is by AI.
Yeah, I'd just say, for some perspective, like, I started in that last wave, right? Or the first wave of recent technology with internet. And we had started building a technology just to build on the point of go get some practical experience. I mean, I was working inside a company on a problem. I saw how to solve the problem using the internet in a way that it hadn't been used before. I would never have been able to make that connection had I not been working on the problem to begin with. It just so happened that while I was working on that problem and using this thing called the internet to do it, it was 1998. By 1999, if you could get in front of a VC and you had something to do on the internet with a website and to show it to them, you could get money, right? And I was competing with a lot of other more mature technologies that had evolved around me that couldn't get funded. And so I think that the current environment for that, from a .com to now an AI is very similar. I think that you do have to have a real problem. I think you have to have real experience in solving that problem with the new technology. But if you do have that insight and you're seeing how the new technology can be applied, it's a really magical time to raise capital for that because the whole world is looking at it. And I think the impact of the overall wave is going to be, probably bigger this time than what the web was the first time. Because the internet, to some degree, was plumbing, and then it was content. It connected us, it connected processes and systems and data, but it wasn't intelligent. It didn't think. And when you add intelligence to any situation, the order of magnitude of returns you can get on the overall infrastructure you've already built is multiples and magnified. I mean, look at what happens when you put the right person into any situation and it just takes off. The same catalytical capability is now present in this technology. So when we decided to start our latest company, it was one of my engineers, he was CEO of the past company that we ran for 10 years and sold, came to me and said, let's do it again, put the band back together and make another run. And I said, great, I got like 4 or 5 ideas. And he says, none of those matter. We're doing AI. He was smart enough to talk me into that 2 years ago. So we've had a 2-year kind of head start on a little bit of the bubble and using the early models and applying them. And, I continued to be amazed virtually every day with the underlying potential that this technology provides us as it's applied to real business problems. I mean, I think as you guys think about AI, none of us in the room, frankly, is going to be dropping, the next $100 billion on the next model builder, right? That part of the ecosystem is already being dominated, certainly first by Google and now by the derivatives of that OpenAI and others are providing. But that is simply, to me, that's like the browser, when it got invented and then we had the router and then we had, connectivity. Those companies made a lot of money early, but most of the money was made in applications later solving real problems with those tools. So the tool providers come first and then you launch solutions. And we're just now barely starting on the solution phase, which is why there's going to be a massive wave of investments because those problem-solving opportunities with the new technology are now just getting the first glimpses of into the market being applied. And that's where the wave really starts to hit. It's not with the tool creation, it's an application of the tools to solve real problems.
I agree with everything that you were saying. I was just going to suggest that at least in a lot of the other, maybe not AI, but things like nanotech, right? Or just maybe 4 or 5 years ago in the health world, technology-enabled health services, right? So these things that COVID, for example, generated, they can have a really, you've got to get on that curve and money's sort of flying into those spaces. But there's going to be a time when it starts coming down, and there's also a dip. In other words, you can go below where actually it can be a problem if you're trying to re-raise money or move to the next stage. And so, for example, I would suggest that one of those areas right now is aging. Like if you have an aging company that has a thesis, a real thesis, there is so much money that is flowing into that. Clemson has just an awesome aging opportunity sitting within its science and its professors. But in planning out how to create those stories, the assessment is we're on the back end of that wave. And so you need enough to be able to survive the trough. So what is that story? It's not as easy as just getting on the train because the train will eventually start switching cars and there's going to be another hot topic. So
I think maybe to further that point, the AI tools are incredible and the speed at which things are evolving is incredible. So on the one hand, that means that to some degree, raising capital, if you have a unique application, might move faster and more aggressively than you would otherwise expect. But on the flip side of that coin, we also know how easy and fast it is for others to try to replicate that or compete against that. So it actually makes our job as capital allocators maybe a little bit trickier in the sense that it's a little bit hard to know where to place the bet as things are evolving as quickly as they are. And so I think some of this, how this plays out in terms of where those applications really drive value creation, defensible value creation, is going to require, I think, to your point, sort of at the lower level of really getting first mover advantage and really getting entrenched in a particular niche or industry where you can get far enough ahead if you're moving quickly to give you some defensible position. But I think the competitive wave that's going to follow is going to be intense as well. So it makes it a little bit tricky.
We're going to wrap up the VC panel here, but like, let's give it up for these guys. That was kind of gold there, right? I just want to like, just to close it out, I want to say like that whole topic of relationships that we talked about, like, I don't know, maybe the start of the relationship that's going to lead to your raising your first round of capital could start with one of these guys. So like, don't be scared to come up to them afterwards or at a break and introduce yourself and be like, that was cool. Like, I got another question for you. I'm sure that they'd be open, right?
You guys touched on different relationships y'all have and how you build them and how that creates, you know, a huge network for yourself. How do you guys differentiate relationships, whether it's like being a mentor, seeking mentorship, whether you're talking to a manager, client, customer, apprentice? How do you guys approach those relationships, or how do you differentiate those?
I'll start by saying, in fact, I don't. I mean, the relationship was with the person, and that's where my focus is, and that is going to ebb and flow over time. A fun fact that one of the other folks here was a former student of mine. So when I met him, that was the relationship. Now, years later, we're reconnecting, and it's a very different relationship. But it's the same two people involved, and because I don't segment that, you know, so in some sense, and I know that's not the answer you're looking for, but I would say is let the nature of the initial relationship guide you. Because if you're looking for mentors, then they should fit a certain profile. If you're looking to develop relationships with investors, then they should fit a profile. But then after that, let the actual relationship take over and let it, you know, blossom according to the two people that are in it.
I try to see each relationship that sort of moves into my orbit. How can I serve into that relationship? So, you know, everybody that you mentioned, they're just trying to do their job. They're just trying to do the best that they can. And they all have something that you might be able to help them with. So I look for that and you go from there.
Yeah, I think that's great guidance. I would say probably the single most impactful relationships that helped me career-wise started with me meeting somebody that I saw a way to help. And it was just, whether I wasn't looking to get anything out of it, I just saw an opportunity to say, no, I have a way to help that person. And lo and behold, a year later, in one case, 10 years later, that turned out to be a transformative relationship in my life. But I wasn't looking for anything. It wasn't transactional. I didn't say, oh, I need a relationship in this sector. I just focused on the person. You know, like you said earlier, it's an individual relationship. It's got to be genuine, or it won't be service any of you, whether you or them. But start by just leaning in and looking for places you can help, and that will come back around.
Mentors need mentees,
Mm-hmm.
you know, for example.
Maybe just one other follow-up on that point. I think a lot of the advice you're going to get as you're thinking about transitioning your career is follow your passion. And sometimes that's good advice, but it's not always the best advice. So I would say, kind of along the lines of what these guys were saying, bring your passion with you. But the real way to really navigate your career is to find ways to create value for other people. That will lead you to opportunities, whether it's entrepreneurial or in the company that you're working for. And as you are able to demonstrate that you create value for other people, it'll turn out that a lot of times that will ultimately become your passion. And so, not that you shouldn't pursue passions if you have them and you have a viable pathway to make a career out of that, but sometimes I think that can be a little bit of misleading sort of conventional wisdom that maybe if you flip that around, because thinking about your passion is often a sort of a selfish endeavor, flip that around and think about how you create value for others, and that will open up some new opportunities for you.
Coming here today, my question has to do with kind of the end of our talk and AI. And so if we are truly in like an AI bubble and, like you said, with the winners already being picked with Google and OpenAI and, potentially winners down the line 5 years from now, solidifying it, how does a student who has aspirations navigate the challenge of gaining industry experience coming out of college or technology?
Yeah, well, I would say don't take my earlier comments that the winners have already been named. Those are just the tool builders, right? Like they're creating the tools with which the winners will be built. And so we're at the first innings of this game, not the last. So I think that's one clarification is important. Two, I think it gets back to, you can't start with, oh, I want to build an AI company. That doesn't work. But you have to start with, there's a problem I can solve. There's a person I can help. There's a customer I can add value to. There's work I can improve. And then you can see how AI could be applied to that to make it better, faster, cheaper, more scalable, right? And then there might be an opportunity to use AI and apply it to a business, to create a company, to solve a problem, create a product line, who knows? But, I see that a lot with, certain people chasing the wave to a degree. I mean, I think our messaging is important to say, it's important to be aware of the waves that are, coming at you and that you might be able to ride. But you can't chase that with a false sense of like, oh, I just want to do this because I put AI on my business plan. Like people will see through that pretty quickly. You have to be solving a real problem.
Yeah, and I'm getting the highest sign to close.
All right.
I'm going to do one little just jump off there. Like I'm working with two companies right now. One is a company out of Australia, and they're a customer service platform that sells specifically to financial institutions that's powered by AI, very niched. Another one out of Austin, they do property management platform powered by AI, very niche. So I think that's a real life demonstration of what Doug is saying. Like the AI thing is the thing, but like there's all these little niches that technology can be applied to. So just find your niche. They're out there. They're just waiting for you, right? So, all right, second round of applause. Good job, guys. Appreciate it.
Hi, while my colleagues are getting wired up and we're going through the change, I'm Dan Townsend. I'm a partner at New Second Capital, which is a specialized New York-based private equity firm. I started my career after graduating from Clemson in 1991 as a mechanical engineer. I loved mechanical engineering, but what I found out is I worked through several of the GE businesses, which is the firm that I joined. What I really started to figure that I enjoyed was what people were doing with the businesses that I was working in. And so I kept my head up and I asked a lot of questions, and I went back to business school, got my MBA, went to invest money for GE's pension fund in private equity, and just fell in love with the industry. You meet some of the most interesting people in the world, going through really quickening times, and I was there to either help them hopefully succeed, but also witness a few failures along the way. And luckily, I had more successes than failures, and got the right to kind of continue doing on in this business. Right after the global financial crisis, I left GE and joined a firm called Paul Capital. It was a very traumatic time because the thing that I went there to raise failed. But we regrouped, and my partners and I, or a grouping of my partners and I, linked arms, and we spun out of Paul Capital, the firm Top Tier Capital Partners, which is the large venture capital fund of funds on the West Coast. I led a product there that was focused on secondaries, which was one of the specialties that you kind of heard of in private equity. And in 2016, was looking for the next thing because venture capital is a bit unique, and wanted to do GP-led secondaries in private equity, which is a very specific thing. And linked up with some partners from another firm, stared at each other in a WeWork, the four of us, and we built a business. And 10 years later, we've got a business that is $2.4 billion of assets under management, and we got 20 people, and we're finishing up our third fund. Before we get into our panel here, I was told to give a little bit of an overview, like what Matt did, on what private equity is, and try to bring it to the most basic levels. So, private equity, it's buying a private company that's not public. It's really quite that simple, to be honest, in this most basic effect. It would be similar to going to the dairy and ice creamery business here at Clemson University and figuring out how to buy it, buying it, and bang, that's private equity. But if you want to run a private equity business, it's a little more complicated than that because, first of all, I've got to find the person at Clemson to talk to. I've got to execute that purchase. Now I've got the company. I've got to do something with it. So maybe I roll it out to all of the campuses across the United States, and I sell it to Ben and Jerry's for a bunch of money. So that's kind of the cycle. But even that's not enough. I've got to have a designed portfolio, and I've got to be able to manage people's money, and it's got to be a repeatable strategy. So I've got to craft something that, ice cream businesses are too small. So is this consumer? Is this roll-ups? What's my theme? How do I put together the pieces and the teams to be able to make this a repeatable business? And then, and most importantly, I've got to have distribution. I've got to find investors that will believe in my financial product. Now we're 3 steps away from the actual investing into something, and we got to raise money and bring that together in a fund portion so we can get that out. Doing all 3 of those things is very complicated, and as an engineer, the last one was really the most complicated. Public speaking, selling myself, trying to put lightning in the bottle so people could trust me and my partners to do those first 2 things. Now, also was suggested to talk a little bit about data, which really warms up a crowd. And but to build on what Peter had said, it's a huge industry out there. There are, if you look at private equity and the adjacent firms that are investing in private equity, and yes, venture capital firms do invest in what I would call private equity outside the early stage venture. There's over 3,500 firms out there that do this, and it changes and evolves every day. So, I mean, these firms get built, and there's no reason why someone in this room can't do that. And those firms sit on top of $6.8 trillion worth of assets. That's just absolutely enormous. And across 78,000 active portfolio companies. So 78,000 ideas like buying the ice creamery here at campus. And the majority of that capital is controlled by, of course, private equity. They'll get the segments back. Private equity, other asset managers, and venture capital. But the BDCs, SBICs, and fund sponsors, quite frank, fundless sponsors, actually, they bubble up all the time. And I think that number is way understated because there's just no data available for it. PitchBook doesn't track it. And if you look at kind of where that money and where those firms reside, not surprisingly, you would expect it to be an 80-20. It's really more of a 90-20. The 10% of the firms out there control well over 50% of the assets, and a huge tail end at the smaller end of firms that control the other half or a good bit of it with firms under $1 billion. And so, what do you do to prepare? You do all these, of course, you read, you're curious, you do business writing, you learn public speaking, all of that. But what this really all boils down to, if I can get my thingy to work right here. Yep, there we go. Just keep asking questions. Be curious, get out there, keep your head up. Whatever industry you go into, private equity, that $6.8 trillion touches everything. So, there's not an industry that private equity hasn't been involved with. And that's kind of my lead in, which is now we're going to pass that on to the panel portion of this. You heard a little bit of my journey, and I think some of the most interesting stories here are coming from the panel here as far as their journeys as well. None of those journeys are linear and all very interesting. Hopefully you can find something in that, and maybe start with John.
Good afternoon. My name is John Bradford. I live in Charlotte, North Carolina. I'm a Clemson graduate of 1996. I was an engineering student, worked for ExxonMobil, eventually got an MBA, went to IBM. And along the way, I somehow found myself in property management. I was buying real estate as a hobby and grew a property management company. Somehow got involved in politics. I was a town councilman, then I served in the North Carolina General Assembly and the House of Representatives for almost a decade. I just finished in December. And then I started a software company. So I own the reason I think I'm here today is from a founder perspective. So I am not a PE person, but I have most certainly started working with PE in my own journey as a founder-led company. So we raised some money in January, and it was with private equity. I bootstrapped my own company, but look, I don't know what I said before I came. I'd yield to the experts. I can just only share my experience as a founder. But my company's called Pet Screening, and we screen dogs and cats for the rental housing industry. So if you're moving into an apartment anywhere across America, there's a good chance you'll use our platform. And we just make sure that pet owners understand the rules. I don't think all pit bulls are dangerous. I think it's more about the pet parent. And we try to use data about pets to tell the whole story so the landlord can make a decision that's more appropriate. So we have about 180 employees. 1 out of every 7 rentals in the country is on the pet screening platform. U.S. military, affordable, senior, student housing. My kids go to college. Unfortunately, they didn't go to Clemson, but they said, "Dad, we have to use pet screening." I'm like, oh, that's wonderful. Anyway, so happy to be here today, and look forward to adding whatever value I can to the panel.
And David?
Sure. My name is David Bedard. I'm a parent of 2. I've got a student who graduated in May and one who's a junior here right now, both econ majors. One was a Lyceum scholar. The other kid is Air Force ROTC. Anyway, I know we have a section later on today to talk about careers and things, but I'll give you a short version of who I am. I started life as a research engineer for Shell Oil Company. He's an ExxonMobil guy. But I started for Shell down in Houston, Texas. And then in 1997, before the bulk of you were born, I applied to business school, law school, and dental school. I had no idea what I wanted to do with my life, right? That's basically what it was. But I was in pursuit of money, and the only thing I was in pursuit of was money. A terrible path. I wouldn't give that to anyone. I wouldn't say that to anyone. But I went back to business school, and then I joined J.P. Morgan as a merger and acquisition banker, working in the oil and gas sector because of my background, Shell Oil Company. And I did that. I've run a couple of my own businesses. I did a leverage buyout of a large automotive parts business. I had a plant in China. I had one in India, about 1,100 employees, which I sold. It's currently owned by Berkshire Hathaway. I founded another company, Financial Recovery Technologies, using technology to recover class action claim money for hedge funds out across the country. What else have I done? I've done a bankruptcy workout for a company. I've deployed my own capital in different ventures. I sat on an advisory panel for David Tepper, Appaloosa Capital, back in the early 2000s, deploying capital for his company. He owns the Panthers. Let's see, taught finance at Boston University Questrom School of Business when I retired in 2012. Which I thoroughly enjoyed. Mentoring young men and women for their career in academics and life was extremely rewarding to me. And then 6 months ago, moved down here to Clemson, South Carolina, or actually Seneca on the lake. And I spend a lot of my time roaming through campus, doing different things, trying to connect with students and help you in any way, shape I can. So that's me.
Thank you. And now Tom.
Yeah, so I was like you guys. Clemson grad in 1989. I would not be here on a Friday afternoon. I would have probably been at Tigertown Tavern, especially before the Florida State game. But I'm going to need to go to the Tigertown Tavern before the Florida State game tomorrow. But no, I graduated here, and I thought I'd work on Wall Street. I grew up in Connecticut, and I thought I'd work there. Quickly realized that Wall Street didn't recruit at Clemson in 1989. So I went to grad school. I went to Wake Forest. Quickly realized Wall Street doesn't recruit Clemson and Wake Forest either. So I had no idea how I'd do it. So I took the first job out of grad school I could get, which was in healthcare consulting. I did that at KPMG for a while. We formed a group there called the Health Ventures Group, which is mergers and acquisitions. And it started getting me into that M&A world. So I did that for a little while, went to Eli Lilly and joined their firm in the corporate M&A practice, realized that being part of a big company, the politics and bureaucracy was not something I had the patience for. So I had an opportunity to come back to Atlanta and join Robinson Humphrey's Healthcare Investment Banking Group. And at the time, it was owned by Solomon Smith Barney. You guys would know it as Truist Securities if you're interested in corporate finance. I did that. I thought I'd reached the pinnacle, right? Doing investment banking. I had kids. They were 3 and 4 years old. I kind of like them. Investment banking is not a great job being a dad. You're working 80 hours a week. And I thought, how do I get off this treadmill? It was what I thought I wanted to do. Felt like it was really overrated. 9/11 hit. And I was last banker in, first one out. So took the kids out of the private school we were going to send them to public, which was great. And I started my own healthcare business. There were so many deals when I was an investment banker where I said, man, if that guy can do it, I should be able to do it. So put my house on the line, took out credit cards, took out a personal loan on my home, all those kind of crazy things that gave me a lot of gray hair. But I built a multi-site healthcare business here throughout the Southeast in Georgia and South Carolina. Very fortunate timing on a lot of things. Thank goodness I exited that business in 2006 before the recession. But I sold 80% of it to a private equity fund, rolled 20% equity, and went on the board of the company. At that time, one of the guys who I had worked with 10 years earlier in investment banking, and we'd always kept in touch, and this gets back to the relationship question, I had no idea that 10 years later, he would come to me and say, hey, I want to raise a private equity fund. You want to do it with me? So Jeff and I and another guy, Frank Dalton, who had been at Cordova Ventures, we launched Fulcrum Equity Partners back in 2006. And it was really to fund what's called growth equity. And so this is not venture, where it's pre-revenue. These are companies with revenue. And the healthcare side of our house, they all have EBITDA, cash flow. And on the tech side of our house, they have 3 to 10 million of revenue. But to finance these smaller growth businesses. And so we launched Fulcrum back in 2006. Fast forward, that was our first fund. We raised our second fund in 2012. We raised our third fund in 2017, fourth one in 2021, and closed Fund 5 in 2000 last year. So we're currently investing out of just about a $400 million fund. We've invested in 66 companies over 20 years. So that's me real quick.
Thank you. And as you can tell, we love what we do. We will fill the airwaves with talking, and we can talk about ourselves as much as we want to. Really want to make this as interactive as possible. So if anyone has any questions, jump in. We'll definitely jump to you because we want to make this as interesting as possible to you. But if I have no questions, we'll start talking about what we think you want to hear. So please, any questions? We'll take them now. Sure.
Hey, I was kind of just wondering, what would you say differentiates companies in terms of whenever they're about to get bought? Like, what helps them achieve higher equity multiples or EBIT multiples?
Sure, I'll jump in. You guys jump in. Yeah. So when I look at our world in the tech or healthcare world, on the healthcare side, you have to have compliance. There's so much Medicare, Medicaid fraud and abuse. You have to have everything tied up. So that's the first thing, and that's table stakes. You have to have that. But absolutely, growth rate drives multiples. Margin, of course, drives multiples as well. And the ability, at least, to see that there's a vision. So when we invest in these companies, like I said, they may have 3 or 4 million of EBITDA. We may get them to 15 to 20 million of EBITDA, but the next buyer, which is traditionally large private equity, they have to see a path forward where they can get 3 to 5 times their money. We underwrite every deal to 3 to 5x our capital. Larger private equity traditionally has underwritten it to that level. They're maybe a little smaller these days, but you've got to have a business that has just a completely solid management team, good growth characteristics, good margin, and a good vision for 3 to 5 year growth, where they can make that multiple. And that's key. And that's the same on the software side. There's a number of metrics we look at on the software side: gross margin, net retention, all those kind of things. But really, it comes down to growth, management team, and the ability to underwrite something to a 3 to 4x return.
I'll only add one piece to that. I mean, you could do in the macro environment, you talk about, how do I boost or how do I juice my multiple? It is truly, what is on the horizon for you, right? And we talked about life cycle earlier on the venture panel. We talked about where we are in that curve. Depending on where you are. And remember, private equity, just so we can differentiate again, I know it was said up front, but, venture angel investing, venture investing, risk capital, right? Truly risk capital, maybe no proven sales record on the front end, but truly on the risk side. On the private equity side, right, we've got an operational business. It's already been operating for X number of years, whatever that might be. So we have a track record of revenue generating 100 million, 200 million, whatever it might be. I know we heard some smaller numbers, although private equity firms are starting to chase smaller and smaller deals as time goes on, but I'll leave that for a later discussion. So when we talk about, hey, how do I really juice my exit multiple? Well, we do have a peer group of things, similar type companies that we're playing around with, but truly, where are we on that curve in terms of the macro environment? And do we see a pathway to tremendous future growth, right? Or are we just, this is a mediocre, same old, nothing new here, and you may not exit where you want to be. And the one thing I will say, sorry, is that, some advice when we're thinking of new ideas and we've got some great technology behind us and maybe some wonderful operational efficiencies that we're working with. A lot of people are giving up ownership too early, in the stage, right? Hey, we talked about go meet and talk to guys who want to give you money. Well, you want to give money up front, you're giving away a lot of that company, right? And I know we all have this, and look, I've had 3 or 4 great ideas, and I forget who it was. Peter or someone said early on, it's like, hey, we can all have great ideas, right? But can we really translate that into a business? So patience and timing, I've left a lot of money on the table because I was impatient. Timing was good, but I was impatient. Patience and timing will allow you to truly realize the benefits of whatever it is that you're building, right? Or whatever it is that you're working on. I'll pause there because I'm sure we can talk more about this in a little bit, but since you're running a pet finder,
Yes.
very interesting business, by the way.
Thank you. So I just went through this journey, so I'll share with you what I thought PE companies were looking for in us. One, capital efficiency. We did not have to raise money at all. And when you don't have to raise money, that's a great time to be looking for money because you have the power that if you don't want to raise right now, you don't have to. So we were very capital efficient. They don't want drama trauma amongst your cap table. They don't want drama trauma amongst your executive board. They want product market fit. One could argue that if you have revenue, you're capital efficient. If you're profitable, perhaps, then there must be some sort of product market fit. But then they want to look at TAM, which I learned is total addressable market. What is the TAM here in the U.S.? Do you have TAM potential overseas? I've never been a guy to get big for my britches. In fact, I prefer not to do that at all. So I really keep us controlled growth. I would think we've had opportunities to go overseas, but I said, not yet. There's plenty to do right here in the great US of A. And I felt like they looked at all those things. I learned about this thing called Rule of 40. I learned that when I was doing early stage VC. Rule of 40 is your growth rate plus your margin. And if those two add up to 40 or more, then that's just a very quick sort of litmus test. And you could be a 50% year-over-year growth company and be minus 10% on margin, meaning you're spending you're not making money, but that's still 40%. And they view that as, okay, this is a high growth. And, I'm not always saying they're looking for profitability. They want a road to profitability. We were a PE growth candidate by choice. I mean, no disrespect to PE, but I heard PE takes all the fun out of growing a company because they squeeze out everything because they want to get your margin so high and then they want to flip you out. They want to pull their money off and off they go to another deal. So I was very sensitive to not get myself into a situation where they're going to squeeze the fun out of it because one of my core values is laugh more and have fun. And I want to be able to do that. I did a minority raise, so I still am majority owner of my company. But good governance, get a good attorney. I tell you what, if there's one thing I did smart, and I don't think I do a lot of things smart, but I was lucky enough to listen to someone who told me to go get a very, very sharp law firm. It's called Fenwick & West, Silicon Valley, Hong Kong, New York. They're a fortune, but they have kept me out of trouble. They have kept me from making some really dumb decisions I wouldn't have known not to do.
Yeah. Just let me add on to that, because I think that's if somebody was going to ask that question, I would have said, get a good deal attorney. Pick a partner if you're looking to raise money, and especially if it's on a growth equity or venture. I think it's important to have ex-operators, people that have run their own businesses before, that have taken the chance that you're taking. So many private equity funds, and not that there's not great ones that are just a bunch of ex-Goldman or Morgan Stanley bankers, but if you've actually had to build something, that's a big difference. So every one of our partners in our firm is an ex-operator. And even our younger guys who we bring in that are going to be partner ready, we put them in an operating role to understand. Now, it's not the same thing as starting your own thing, but you need to find somebody that empathizes with the entrepreneur a little bit, because you're exactly right. There's some PE funds that it's a chop shop, man. They're going to look at the numbers. They're going to play some 28-year-old kid from Harvard and tell you what to do. Get somebody that has actually done it themselves before. It makes a difference.
Just one more thing. David's right. Listen, I was being contemplated if companies would even invest in me if I thought about running for governor. They didn't want to invest in a company where the founder was going to be distracted. So founder-led companies who are all in is definitely something they look for.
Yeah.
And just kind of wrap it in with some of the strategy that we do. What we do as a secondary firm is and in fact, there was already a meeting in the books with Tom for next week to have this conversation. But are there assets that where some of his investors might need to have some liquidity? We would potentially, as a secondary firm, provide liquidity options to that, such that operators like these two gentlemen here, David and John, can actually get the work done. Potentially provide a little extra capital because maybe those couple of portfolio companies in Tom's fund have been strangled a little bit because the fund's at the end of its life, or because some of their investors are a little tired and don't want to be on the journey anymore. We can provide that, reestablish an urgency, put together some incentives such that the gentleman on the table here can really drive value.
You know what I think is interesting about what you talked about, and I think might be helpful to the audience. When we talk about raising a fund, we talk about a general partner, we talk about limited partners, right? Limited partners kicking the unless you don't want to go here right now. Okay, right. So, limited partners kicking in the money, right? And talk about a 3 to 5 to 7 year horizon, whatever the timetable is for this private equity firm to say, look, yep, we buy a company, operational efficiency, which really means they squeeze the heck out of it, take all the money, we'll lever this company up like no tomorrow, we'll pay oh, sorry, this is going in the wrong direction. But I think that the question is, so you got these LPs who come in. I think it's fascinating because you got LPs and typically when you're an LP in one of these funds, right, Fund A, Fund B, Fund 1, Fund 2, you're in for the long haul, right? You are beholden to whatever the GP is doing, right? And you may get to a point where you need to exit. So if you could tell me though, so I'm an LP, right, and I want to exit. How do you value, my share or wherever I am in terms of getting out of Fund A, B, C?
It's actually usually pretty easy in a strange way. Unlike what you would expect, that we would come in and set a price and then people argue about the price, with the GP-led secondaries that we do, typically there's already a little bit of tension around that price because the general partner has been talking, so the manager has been talking to the limited partners, the investors, and they've been talking about the strategy of the fund. They've been talking about the valuation of the portfolio assets. They're talking about what needs to be invested and what the new risk return profile going forward is going to be. And during that discussion, some of the investors say, look, I understand what you're doing and why you want to go down this next phase of the journey of growth. But to be honest, for a fair price, and I think it's kind of fairly priced, I'd rather take my money. And so what we're in the business of doing is offering that fair price, quite frankly, that has already been, if you will, found out between the parties around the table. And we provide capital to help clear that price, to be honest.
And then do you become the new LP?
And then we become a new LP. In many cases, we are the majority LP now of that structure. So if you've been reading in the newspaper things about continuation vehicles and secondaries, that's all we do. And so in that vehicle for our transactions, we've done 30 of them at this point in time. We are either the largest or all of the capital that goes in for that. So structurally a limited partner, and yet we're a very involved limited partner, if you will.
I'm Connor Dixon. I'm a CPA. You mentioned having relationships with great attorneys. I just wanted to ask, a lot of my clients have been bought. They're a lot in the defense space out of DC, so this has been a pretty hot market post-COVID. It's kind of a tough time right now. But what are some of the keys for having strong relationships with your service providers, like attorneys, accountants, those things?
As a founder, again, just my narrow experience, obviously a good, and we have chief legal counsel inside of our organization, but Fenwick is our corporate counsel as it relates to governance, et cetera. So get a good attorney, probably inside and outside. We were encouraged to get audited financials before any investor ever required us to have them, because that way, when it came around, it showed that we had our act together. So we were doing audited financials a year before the first person even requested audited financials. So I think getting a good CPA firm, and I live in Charlotte, and I didn't even really use Charlotte-based firms. It's a great city, but I mean, sometimes you have to look outside of your city, right? So be careful, in my opinion, be careful going with a good friend of a friend. This is business. You need to probably use reputable sources to the extent that you can. I do want to touch on dilution. Doug Ha before mentioned it. We kind of heard it up here. Let me tell you something, like, it's so easy to just partner with somebody and give them share because it's kind of like funny money, right? You don't really know what you have yet. Just measure twice and cut once on that, because even if you're 100% owner, period, the first time you raise money, you're instantly a 90% owner. And that's before they even give you $1. Then they're going to dilute you. And when you say, well, how do you go from 100 to 90? Because the first thing those investors do is they make you do a 10% carve-out pool for options. And those are options that get set aside for you to go hire talented people to help you grow. Now, if you don't issue all those options and you were to exit, you'd get some of that back. But in reality, very quickly, your piece of the pie just went to 90. And then when the money comes in, you get diluted again. And then the next round. And so it's very quickly it goes away. So I just think be careful there, be wise, be prudent, but also give to get. You have to give equity to get some. Surrounding yourself with really smart people is the smartest thing you can do. The fact you're here today shows me that you're already on that path. But I have Chris James back here. We crossed paths a year ago. Smartest guy I know, went to Clemson. Naturally, of course he did. But he joined our company not too long ago. And I'm so fortunate of bringing people like Chris on board. And sometimes you got to pay for that.
The other thing I'd add to that is the measure twice, cut once on money. Equity is a very, very precious thing. And if you are, in the case of a private equity firm, 5 partners, or in the case of a business, the team that you put together, as soon as you cut that equity investment, yes, you have now money, you have board, you have someone to speak to and provide a return to, but you've also got a human partner that has come into your business that you're going to live with for a very long time. You can't really undo those relationships very quickly. So measure twice and cut once on that as well.
One thing I would just say is as an entrepreneur on this, and then I'll address your service provider question too, but is alignment on vision, because a lot of PE funds and a lot have very different visions. And you got to make sure you got to dig in deep, because these are marriages. Make no mistake about it. When you do this, you're all in. And so you got to make sure there's an alignment on both sides of the table before you go forward. And that can be very different. So do a lot of vetting on that. And if you're going to get references from other portfolio companies, and don't get the ones that they give you. You got to go around that. You can see where they all invest, talk to other people, make sure you vet it, because that's very important. Service provider question, I'll just real quick. I always say you hire a lawyer, not a law firm. I don't go to a law firm. You hire a guy who you trust is a good business attorney. And I would hire the guy I've all used for all the deals we've done in 20 years. If he left to go to another firm, I'd go with him. And so that relationship is very important, because he knows me and I know him, and he's very fair and he's very business minded. He doesn't over lawyer stuff. And then when it comes to other service providers, accountants, to me, it's just very industry specific, because we're so siloed in healthcare and technology. They got to have expertise in those 2 areas. If they don't have it, we don't even talk to them. And then it's kind of comes down to price, honestly. But sorry.
The one thing I would add, if I may, first deal I worked on coming out of business school, working for JP Morgan, was the Enron bankruptcy. One of the first deals. It wasn't the first deal. It was a first deal. And Enron, if you haven't watched the movie, read the book, smartest guy in the room, Jeff Skilling, Ken Lay. The one thing I'll tell you about these relationships with service providers, auditors, lawyers, et cetera, the big downfall, one of the big drivers for the Enron bankruptcy, the Enron downfall, we won't talk about WorldCom, Tyco, and other places, but it was the relationship that they had with their accounting firm, right? Arthur Anderson, which no longer. And that relationship, because it was built over years and years and years of service and relationship, which we can talk about Sarbanes-Oxley after that. That's the law that came into place after this bankruptcy. But the relationship got so tight that senior managers were able to ask accountants or others, and I'm paraphrasing, right, to look the other way when maybe we weren't going to hit our earnings, when I need to move some of these liabilities off my balance sheet into what was called Raptors at the time. This is an Enron term. So, and it's very easy to fall into this relationship because you've got years of togetherness and I'll junkets to fishing trips and steak dinners and all this other great stuff, which does happen. And we're all fooling ourselves sitting here in this room today if we don't think that that's going to happen, because it does, right? Greed is good. What did Michael Douglas say in the movie Wall Street? Greed is good. A whole nother topic that we could discuss. But you know, what these two guys said, yes, picking your service provider is absolute, you know, a must. Reviewing your service provider maybe every so often, well, it's a must due to Sarbanes-Oxley, but anyway, reviewing that relationship, I think, is doubly important, because you can get it down a path too far with a person, and you've really started to have, you know, different views of opinion. So I think that was a great question, because it's of utmost importance, you know, who are you surrounding yourself with?
Yeah, and the only thing I would add to the panel here is you want to partner with service providers that have the same urgency that you have for your own business, which sounds like it would make sense, but it is not always the case. You really need to have people run as fast as you do. We're getting a little close on time, so wanted to make sure that we address this one question, which is which I'll give to each one of the panelists. What advice would you give to the people in this room that might be seeking a career either directly in private equity or adjacent to private equity?
Well, I mean, I'm not in private equity. I just happen to be now working with private equity. You know, I mean, as a founder, I would just say that the best ideas are the ones that are actually pursued. A good idea that's never pursued was just an idea. So if you think you have an idea, and if you're compelled by it, quit talking about it and go do it. And if you fall on your knees, your face, there's a lot of scabs on this body, you be tenacious, get back up, do it again. Don't ask your family if it's a great idea. They're going to tell you it's a wonderful idea, because they're not going to tell you it's a bad idea, because you're family. You know, get out there and get honest opinions. And so if there's any advice I have, is put your money where your mouth is, shut up and do the work, and lead by example. And if you can do that, then you'll start to see people will gravitate to you. And when you lead by example, they want to be around you. And then you'll attract talent that's kind of like you. And then that starts to become the framework of the people that will help you get to the next level. And that has nothing to do with money. That's just, like, to me, common sense. And when you finally can get to the point where you can maybe go raise money, be smart about it. Driving to the highest valuation is not the right answer, I don't think. I mean, obviously be smart, don't give anything away. But at the same time, getting the right private equity, we had 8 term sheets, one of them being Blackstone. Blackstone was great, but that was just a nice logo. I thought they were too PE for me, because they are PE. So I didn't choose them. Choose the partners that you have the best personality fit, because you will be married to them, like it or not. That's the best guidance I have.
On the hiring, you want just that? Because we're hiring somebody right now. It's hard. Private equity is hard to get into, because typically the only time that we're hiring, and most are hiring, is when they're raising a new fund, and it's typically larger, because the way we fund our operations is a management fee off of the capital raised. And so if you're a certain size, when you raise the next fund, you might have room to add another associate, another senior associate, whatever the case may be. Typically, private equity, not all, but typically, and the bigger shops are different, but we're hiring people 2 to 3 years of investment banking experience. So if you have an interest in it, that's a way to start getting into it. If you can do internships as much as you can before you graduate, because those investment banking jobs and/or private equity jobs are intensely competitive. And it's better today here than it was in 1989, but still Clemson isn't as much on the radar screen as Duke or Virginia or those schools. It's just the reality. It doesn't mean anything. I mean, there's plenty of bright people. We've hired 2 from Georgia. They have a corporate finance program, and the people in that corporate finance program, they get jobs at Citibank. And we've hired 2 guys that had 2 years of Citibank experience and then 2 years of private equity, and then they wanted to come back south, and because there's just not a lot of funds here in the South. And so that has been a good model for us, but it's intensely competitive. But if you have an interest in it, I'm offering, talk to me about it. I'm happy to talk to anyone of you guys about this. We have an internship program. Others have internship programs. Get that on your resume before you graduate, because if you don't, you're already behind. I mean, it's just the reality in the space. It's a very competitive area.
Well, thank you. There are 2 paths to get to private equity, right? And we talked about investment banking. Hands down, the best way to get into a meaningful private equity shop is through investment banking, right? And how do you get to investment banking? We talked about internships throughout the years, and we can talk a lot more about that, but also from the operator side, right? So I say there are 2 tracks to get into private equity, either from an investment banking understanding finance perspective, or an operator perspective. So you're out working for ExxonMobil or whoever else you might be working for from an operator's perspective, you have a pathway into private equity at that point. But both of those require, time in the saddle. you know, it's going to be very difficult to get private equity job coming out of undergrad without any of this other stuff. Very difficult. And if you end up at one of those shops, well, congratulations.
And the other thing, when you do, wherever you go, you never know what work is with as many senior leaders on those teams as possible. You have no idea where those relationships are going to take you. And be the go-to guy or girl at every shop you're at. I had no idea when I was 26 years old, when I was doing investment banking, we brought in 2 senior people. I tried to do deals for both those guys. It was a pain. I was working all the time. I didn't know 10 years later, this guy was going to ask me to start a private equity fund with him. I had no idea. I didn't have any expectations about it. Just be the go-to person wherever you are and keep those relationships. Do not burn any bridges because you just never know where that's going to take you.
That's very excellent advice, all of that. I would agree with everything that was said. Any last questions from the audience?
Hi, guys. Thank you so much for coming today. My name is Zach. I'm a junior at Clemson University. I'm from New York. I currently have an internship this summer where I'm going to be working at a corporate bank in Atlanta. I'm very excited. I know there are also a few other people in the room who are going to be working in banking or in finance, but not necessarily in investment banking. What would you guys recommend that we do when we're at our internship, at our jobs in that field, and try to set ourselves apart to try to follow the same track that you guys are, especially because you went from IB to PE? Thank you.
I would say it's nearly impossible, right, for you to make a move from corporate banking, whatever this firm is, if they have an investment banking arm, right? I would say it's nearly impossible, right? So, you know, if I were you in this summer internship down in Atlanta, you know, I'd be going to whoever's having a happy hour. I don't know, you know, make a list of the 30 or 50 investment banks or asset managers that you have down in Atlanta, and I would start knocking on doors. Not to the point where the whoever you're working for knows that you're going to all these happy hours of things that you're doing, but I would use your, you know, 9 or 10 weeks that you have coming up down in Atlanta to continue your network. I know you said you're from New York, so I'd, you know, maybe can fly up on a couple weekends to do, because I know we did this on Wall Street, you know, had plenty of these activities going on. But back to the primary question, it's very challenging. I shouldn't say nearly impossible. It's very challenging for, you know, starting off on that corporate banking track to then all of a sudden say, hey, you know, I'd like to slide over to your investment banking role here at XYZ Bank. It's tough. It really is.
Yeah, I agree. I mean, you know, ultimately, you almost have to pivot. I don't even know if kids get their MBA degree anymore. I don't know if that thing may be passé, but that's a way to certainly pivot out of corporate banking to investment banking. Great advice. I mean, take as many shots on goal as you can. I did the same thing. I was in an accounting job. Like, that was not what I wanted to do. Venture Atlanta is a great thing to go to. Go there. You can sign up. You can go. You can meet a lot of different people. Getting out there and being aggressive that way is a way to make that kind of pivot, though.
And while you're at your corporate banking job, meet as many people there as you can and understand their career path too.
Yep.
Understand how that business works.
Let me just one last thing from Mr. New York back there. You want to walk away from this coming summer with an offer. You want an offer. Whether you take it or not, that's not the deal. So to the last piece of advice, which, yes, meet all the people you can, but don't ever tip them off that you're expanding your horizon. You want an offer coming out of summer 2026.
My name is Matthew Golden. I'm a private client advisor with JP Morgan Chase right here in Clemson. I have a number of clients who are roofers, plumbers, real estate developers, things like that. They've all been approached by private equity. Some of them have sold their businesses, portions thereof, to private equity, probably too early, to some of your points earlier. What we're seeing is that private equity is really getting into the weeds as far as small and smaller businesses. And I just was curious what your insights are around that. Is that kind of the trend? Just because of your expertise and experience, wanted to get your thoughts on that.
Yeah, I mean, our thesis was that there was a lot of small companies that needed capital. And so that's why we'll invest as little as $5 million. So we do stage our investments, and we invest smaller in smaller businesses to get them to another level. And then we do another round if it makes sense. We are starting to see that some New York firms come down to especially on the tech side, more on the tech side, where they may invest in a company that has 6 or 7 million of ARR, whereas Insight would never think about doing something like that, 10 years ago. I mean, so we're starting to see more of that. Again, if they're ex-operators and they're a good partner to help them really grow and not steal the company, I mean, there's a lot of negativity around private equity, and probably rightfully so. It's really at the larger end, I would say. So you got to be careful. And there's some firm funds I would never partner with. And I can tell you who they are right now. I would never go into a deal with another private equity firm, some of these in New York. But for the right partner, if they've done it before and there's a track record, they have a good history and all that, then it can help them. But we are starting to see that come down to much smaller deals than traditionally.
And I mean, we have several companies in our portfolio that are doing those types of things. And so, specifically HVAC, plumbing, and some of those other things. What I would suggest to your clients, though, is you can make your company operate as cleanly and as sharply as you can. You can implement technology, good, get off of paper books and implement technology, run the company well, get advice. And then it can be a very positive exit for them if they want to do it. A partial exit at least, but I would echo the thought of, when you trade in equity, you want to make sure that you get a good partner, because you're going to have a piece of that equity going forward, and they're going to ask you to stay on.
All right. That was awesome.
Thank you.
Great.
Thank you.
While we're getting mic'd up, I wanted to
do this a lot.
sort of add some insight from the last session, the question about getting into private equity and investment banking. Just kind of share my story of how I got into investment banking after spending a bunch of years in marketing jobs coming out of Clemson, living in New York, knowing I wanted to get into the investment banking industry. I was, as I mentioned, if you guys were here at the beginning, I worked in corporate development for a small media and technology company. So I was the one interfacing with our investment bankers, looking at companies to potentially buy and raise capital from private equity. So I took the opportunity just to get close to the partners of that firm, build a relationship, understand like what it takes to be successful in investment banking at this firm in particular that specialized in the industries that I operated in and I really wanted to stay involved in. So actually I was in the middle of getting my MBA at NYU, going to school at night part-time because I had a great program where you didn't have to leave to go back full-time. And I went to this firm and offered to come into their firm essentially as a part-time associate. So it was an easy decision for them. We knew each other. They knew I understood the industries they were advising in, given I was a quasi-client at the time. And then offering to go in as a part-time person while I knew I needed to spend a bunch of time in school as well. It just made it easy for them to say yes, like a known quantity. They didn't have to make a big decision about bringing on a new full-time person. That's, if you've looked at investment banking jobs, you know how expensive it is to hire someone and pay someone in a competitive marketplace. So it just made it easy for them, knowing that like I was going to learn being on the job. So being trained, essentially being paid to learn how to do this job when I really didn't have the skill yet to do it. So I just took that chance on myself, knowing that this was the right path to get into it. Kind of had to make a bold move, given that I didn't have the education credentials to be in investment banking in New York at this firm. And it all worked out. Like I knew like, all right, I'm going to learn, I'm going to figure out this industry. Worst case, I've gotten some experience. I will finish my MBA and I can go through the recruiting process at all these other firms. But long story short, it was a great firm, had a great experience. Immediately, like 3 months in, they made me full-time. They paid for my MBA, and I stayed there for 10 years as a partner. So just a, kind of an anecdote around like some of those times you have to take a real chance and make a bet on yourself. And one of the other questions around, in terms of coursework to get into investment banking, I agree it's hard because there really isn't like a major in investment banking. But as we're going to talk about in this session in private credit, it's become a huge industry. And which means there's a lot of money to put to work. There's a lot of money under management. There are a lot of firms operating in this environment. We hire a lot of people out of investment banking because they're well-trained in terms of just processing deals. But there are a lot of kids we hire from credit backgrounds. So just traditional corporate credit underwriting, knowing how to look at a company, understand the risks of investing money at the top of the capital stack, which is, I think, what we're going to talk about here next. So just wanted to share that, like, if you're interested in the private credit market, which you very much should be interested in, and hopefully our esteemed panel will enlighten us more about this industry. There is a path coming out of college if you have the opportunity to study corporate finance, accounting, being trained essentially as a corporate banker. Those people are getting hired left and right into the private credit space. So our panelists here, I will not read their names because they're going to share their story here in a minute. I did want to kind of relook at the size of this industry. It's a $6 to $7 trillion marketplace today. These numbers are even stale, the 5 to 6 that we put up on the screen. It's a very fast-growing industry. It was almost non-existent 20 years ago. Today, getting close to $7 trillion in the entire, if you think of all the private credit and other alternative space. And then just looking in at the private credit direct lending business is almost $2 trillion, projected to go to $4 trillion. And then I looked up, fast-growing, big industry, creating a lot of wealth. I looked up, there was an article, if you guys saw in Bloomberg a couple of months ago, about the creation of billionaires in private credit. There are 17 billionaires in the private credit industry, at least based on public information. So firms like Ares, Apollo, Cliffwater, Golub, Blue Owl, there are 17 people who are now billionaires as a result of being in this industry. So I'm not saying get into it for the money. All I'm saying is, like, there is a lot of wealth being generated because this is a very attractive industry. It's huge and it's getting bigger. So what is it comprised of? Private credit, direct lending really has disrupted the syndicated loan market and the high yield market, same size as those two marketplaces, which were completely different 20 years ago. The other areas of alternatives, which we'll touch on this panel, real estate, office, industrial, residential, infrastructure, which we talked a little bit about earlier, which is a huge focus in digital infrastructure as well as energy transformation. We've got asset-backed. We've got a couple of experts in the asset-backed world on our panel this afternoon. And then secondaries, which Dan Townsend touched on a little bit earlier in the private equity session, did a great job. So we're going to try and get through some of this. We got 45 minutes. There's no way we're going to talk all we need to about a $6 trillion marketplace. But I do want to really have our panelists focus on their journey and share with you all how they got to where they are, and a lot about, like, what is it like to work in this industry, kind of what are the puts and takes.
The reason I'm here is because my son is a student here. He's actually started more companies than I have. I'm very proud of that. But I started one company about 27 years ago, and it happens to be in the investment space. And it's called Capitala Group. When I started it, I went to my business school, had an equivalent of what is like this, a launch pad. And I really networked heavily into that launch pad. It wasn't called that, but it's the same concept. And it really helped me recruit investors, really focus on the fund I was raising. That first $5 million you raised was really hard at that time. Now we're $4 billion in assets. We're one of the larger groups in our strategy, which is to provide debt and equity to small companies throughout the U.S. We've invested in about 300 companies. We only invest in the U.S., and now most of our investors are very large institutions like a Clemson endowment, like insurance companies, a lot of banks. Happy to be here. I want this to be interactive. Please ask questions. And what I have committed to do is, if you're trying to go in the path of Wall Street, and Wall Street doesn't necessarily mean New York, but that's most of it, but Dallas, Charlotte, South Florida, is internships are very, very important. Your internship before your last year, that's where you get your first offer. That was talked about a little bit in the prior panel. We focus on the internship before that. So it's after your sophomore year. We are committed to providing at least one internship to Clemson students. We have a great intern program. We have 5 to 6 interns a year. That is a very big stepping stone to getting that next internship, which is getting a job. So if you want to go into finance, into the Wall Street path, those internships are very important.
Hello, Ken Bruce, class of '89. I've financial management. I've got 2 daughters here. One is in marketing and one is in pre-business. I feel like I underwrite a better part of Clemson University through out-of-state tuition and my IPTAY contribution. So nice to see you all. I look forward to having some conversations over the afternoon about your interest in private capital or just investment banking or financial management in general. I work with a company called Rhythm Capital. It's an $8 billion publicly traded company. It runs about $80 billion of capital, both through its balance sheet as well as through funds. We've been growing quite rapidly. Peter was nice enough to include some of the pending acquisitions that we've got coming up, which is going to move us more closely into the private credit part of the marketplace where we're looking to grow. And I think the numbers actually are understated. I look at private credit as being probably today over 13 trillion, and probably as we look at it over the next few years is going to be growing at a very healthy clip. We can get into some of the reasons why that is. I've been following this sector really before it was called private credit. One of the earlier guests was talking about coming out into his professional career around the financial crisis. I would say I came out in a financial crisis also, but it was a savings and loan crisis. So it was quite a few more years before that. My background is I spent about 13 years in mortgage capital markets. Had a variety of roles. Ultimately, it led me to be the chief investment officer for a thrift that allowed me to have a lot of deep understanding of the U.S. residential finance market. Like many of you, I was interested in Wall Street, so I went back to school, did my MBA at University of California at Berkeley. Also did the nighttime program. It was an excellent opportunity for me to do a career switch from mortgage capital markets into equity capital markets. So I spent 20 years being a sell-side stock analyst. I followed the specialty finance sector. That sector comprised everything from the payment sector, what is now Visa and MasterCard, but at the time they were not even public companies. So it was companies like American Express and Capital One. It was the mortgage finance space, which included Fannie Mae, Freddie Mac, companies that are now back into the mainstream headlines because they're potentially coming out of conservatorship. I was there before they went into conservatorship, just to date myself a little bit, and ultimately spent 20 years looking at companies that were either in the public markets. So I'm a little bit of a connective tissue individual here. I work mostly in public capital markets, but ultimately, as I kind of was active in that role, we were looking at a lot of pre-IPO companies. So I got to work with a lot of growth equity companies or companies that were looking to become public enterprises. That's kind of the later stage part of what the private equity panel was talking about. We would take companies that were coming out of the sponsor community and make determinations as to whether they were a good fit for the public markets and ultimately what their valuations were. Great track, had a great run within Wall Street. Got a little tired of the grueling 80-hour work weeks and the like, and ultimately went on to do some advisory work within prop tech and some of the fintech world, working with small companies that were looking for partnerships. They needed some help in terms of their public company readiness and some understanding of how to engage the public markets. And ultimately, I went on to get hired by Rhythm Capital, who was my biggest client, and they had just transitioned from being a externally managed company to an internally managed company. It's a long story, but that's what got me to Rhythm, and we've been very active in private capital. It's a space that we see growing hand over fist because of a lot of the disintermediation around financial institutions And it's a great opportunity for young folks to get involved into a growing space. It's finance has become sexy again to a certain degree. So it's nice to see that there's a lot of interested people moving into the sector. So I probably overspent my time, but thank you.
Hey, good afternoon, everyone. I'm Dominic Trapasso. I typically would be closing down TDs, but I'm getting too old for that. So I was not the other one at the bar last night. I'm much better at happy hours these days. So I look forward to seeing everybody this afternoon. A bit of background on me. I was an accounting major. Again, in '99, I graduated. I grew up in New York. Always wanted to get back to New York after college and started my career at KPMG. Thought it would be a great track to become maybe a partner there or something. And I realized very quickly I didn't want to spend the rest of my life, sort of doing accounting work. And had an inkling of always, going on Wall Street. I really enjoyed my finance classes. So I just took a conscious effort, to pivot. And I was fortunate enough to get in touch with a headhunter that was asking if I had any interest in working at a little old brokerage firm called Lehman Brothers. And they were in the process of integrating their brokerage unit with wealth management. Because back in those days, in the early 2000s, Lehman's high net worth business was very transactional in nature. They would be calling wealthy individuals and asking them, what IPO or bond they wanted to buy, versus today's wealth management, which is much more holistic and fee-based. And so I started my career basically building a family office wealth management business inside of Lehman Brothers. And then our friends in the banking and mortgage division thought it would be fun to put a lot of leverage on some crappy mortgages and almost bring the whole world down. Now, it wasn't just Lehman, it was Merrill and Goldman, and everybody was involved. But unfortunately, Lehman got picked to show the public that, we're not going to put up with these Wall Street maniacs and we're going to let them fail. So thankfully for me, since Clemson, I've been employed every day of my life, even with that story. So Barclays out of the UK bought the Lehman Wealth Management business, and it was probably the strangest thing that happened in my career. I was in a bar in New York watching my favorite New York Giants with my now wife. She was my girlfriend at the time. And I'm like, sorry, I don't have a job anymore. I hope you still want to date. And got a phone call saying, hey, you might want to, clean yourself up and stop drinking beer because you need to get to the office right away. And I was like, this is bizarre. Anyway, walked into the office and there was an email in many of our inboxes saying, welcome to Barclays. And I was like, okay, I guess I have a job. So Barclays bought the wealth management business of Lehman. It was literally an email is how I was communicated, an employee agreement. And we continued on at Barclays. Culturally, that never felt like a fit for a lot of us. And so to fast forward to today, I had some other stops along the way, but about 10 years ago, the former head of Lehman's private client, a gentleman by the name of Jack Peterson, started a firm called Summit Trail Advisors. And Jack slowly started recruiting a lot of us back. And again, long story short, fast forward today, we're one of the largest multifamily offices in the country. We manage about 30 billion in assets. But we don't just do investment work. I do everything in my job in terms of the families I work for. Everything from insurance work, that includes life insurance, property and casualty, trust and estate planning. If my client needs private travel, I get them private travel. If they're interested in concierge doctors and medical, we have doctors and concierge medical groups that we work with. Again, not internally at Summit, but we have third parties that we do this for. And at the end of the day, really what we are is an outsourced family office for some of the wealthiest families in the country that don't want to start their own single family office due to the complexities of running your own single family office. Running your own family office includes hiring people, managing people, and what we have found in the multifamily office space, a lot of these wealthy families like that model better, so they can take care of the scale, and it's much more cost effective for them. So some of my clients include some of the largest private equity GPs in the country. There's 4 billionaires in our client book. We don't manage, obviously, all billion of their assets, but they, just to give you a sense of the type of clientele we work. And now the business really spans across not only private equity professionals, but a number of entrepreneurs that have had large liquidity events as a result of private equity, other business professionals that have sold their businesses, and to a lesser extent, some of the professional athlete crowd. So it's been a crazy journey since I left the Clemson campus, but a very rewarding one. Lots of ups and downs. I'm happy to tell you more about it at the cocktail. And then in terms of the private credit space, I think part of the reason I'm on this panel is private credit is a large allocation from family offices and large families. It's a core tenet of the portfolios that we build for them. So I'm very in tune with what's going on in the private credit space. It's a great place to invest, and it's a great place to help businesses' finances. And frankly, the last thing I'll say is the private credit business really started as a result of what happened at Lehman in 2008. Most of that business was taking place at the large investment banks, and with the regulatory things that came into place after the crisis, the private credit market really left the big banks and went to the asset management industry, and that's why it's grown so much.
You're responsible for the private credit?
Not me personally, but that event is, I think, the triggering event for this market.
My mic's working. Hi, I'm Mimi. I unfortunately did not go to Clemson. I am an NYU grad, but a daughter of a Clemson alum who has the same last name, sitting right there. I graduated school a few years ago. I studied both science and data science, and I wanted to start off my career in finance. I knew I liked math. Knew I probably didn't want to do kind of 120-hour weeks at an investment bank. So I ended up in a product group at a large investment bank called Credit Suisse. So I was working on structured products, specifically specialty finance. So think of anything with a contractual cash flow, call it. So credit cards, student loans, consumer loans, buy now, pay later is probably the closest that you guys would all see. Mortgages, that's the type of product that I was working on. So I worked with that group for about 1.5 years before my group was acquired by Apollo and spun out to a group called Atlas SP. So I moved over to a credit fund to focus specifically on investing in those types of assets and in those companies that originate those types of assets, called Allocators. It was about $10 billion. It was an alternative asset manager. And about this time last year, we were acquired by Blue Owl Capital, which is at, I think today or whenever our earnings come out, closer to about a $300 billion global global asset manager. So also focusing specifically on investing in the financial asset space, alternative credit. And so I'm excited to be here with you guys today to provide hopefully something a little bit closer to college graduation. I have the shortest career out of everybody here, but happy to provide some additional context.
Thank you, Mimi. These next couple of slides, Joe was kind enough to let us borrow his a lot of information in his investor decks to short circuit the process of providing you all with great timely information. In this chart, and Joe, I'll let you do some of the other slides, but I think this is like easy enough for me to understand. Just where the capital stack of any business, split between debt and equity, and really it's like you think about senior debt, it's the top of the capital structure. It is the lowest risk, lowest return piece of the capital structure, all the way from what's called unitranche debt, which is you're doing either first and second lien together, or first lien with some mezzanine behind it, all in one piece of paper, and then the sub debt sort of mezzanine market, sort of to structured equities market, which is higher risk, usually does not have a security interest, but is senior to the, whether that's the common or the preferred equity or both of those, and the equity is at the bottom. It's the highest risk, highest returning, which I think we've covered a lot of that in this. So this is just kind of like the basics of capital structure. I'm sure you guys have studied some of this, but this is we're kind of covering today. It's a good encapsulation of going from sort of pure venture capital to private equity that sort of blends into the sub debt market, to the private credit market, which does the senior secured, to the unitranche, to the sub debt market as well. So we're hopefully covering the entire waterfront of a capital structure of any business in the United States today. And Joe, do you want to talk about like just private credit 101 and like what it is and why it exists?
Well, it exists because of Lehman. They just messed up. It really does. So the regulators push that kind of risky lending activities out of the depository institutions with the Volcker rules of '09 because of Lehman and others. So what's really happened is, regulations created this industry. Mimi's two co-founders are multi-billionaires, and they weren't even here. I knew them 10 years ago when they just started. So it's created this great industry. And if you're looking at coming into finance, we talked about venture, we talked about private equity, you got private credit. Private credit is growing, it's dynamic, and it pays a lot better than banking. So if you're thinking about going on the credit side of things, why not go into private credit? Because you have much more flexible, products and strategies, and you get paid a lot more. So my firm, what we do is we provide both equity and debt capital to small companies. And we define a small company as sort of 5 to 25 million in EBITDA. I did hear a student mention EBITDA earlier today, which is great because I used to do these presentations 15 years ago and no one knew what EBITDA was. Now the trick is when you know the difference between enterprise value and equity value, and we'll get back to that in a second. But private credit, Mimi, everyone get her card. She's going to hire some interns. They hire a huge analyst pool. Blue Owl's one of the best out there, if not the best. But that's it. It's just different forms of debt capital going into small companies that has been pushed out of the banking regulatory system over the past, 15 years?
Ever since Lehman failed. Thanks.
All Lehman's fault.
Created all that wealth for all these
Yeah.
billionaires in private credit.
Well, a lot of the Lehman people are in private credit, so they know where the dead bodies are buried, kind of story.
This next slide just kind of encapsulates the growth of the private credit, really the direct lending piece of the private credit spectrum since the fall of Lehman in 2008. You see the industry kind of bumped along. There really wasn't a direct lending product. That kind of like that blue bar is really the direct lending bucket. That's senior debt. Didn't really exist as an asset class before 2007. That accelerated when regulatory requirements forced the investment banks out of the business and created that opportunity for the Blue Owl folks to become billionaires. So it's a huge asset class today. This is a good snapshot of how that industry has grown out of doing subordinated debt, structured equities, to now it's an enormous asset class in and of itself. And this chart, Joe, I thought was super interesting just to compare private equity and private credit. The one thing, well, a lot of things stand out on this, but just the difference between private equity and private credit, the value levers to creating value in terms of you want to touch on this, just like if you're a private equity investor, how are you creating value for your investment versus if you're a private credit investor?
So really, and this is why we're sort of unique and we do both, is if you're a private credit investor, you're really a lender. So you really cannot impact that business as if you're a private equity investor because you're an owner. Private credit is really just is taking the place of what traditional banking products and services have been. So if you look at what is a bank is, they take deposits, they lever up on average 10 to 1, they make loans. You have to have a very low loss ratio when you're 10 times lever because it can really, harm your equity and ultimately your enterprise value. And that's what happened in the '09 recession, thanks to Lehman. So it all moved to private credit. Private credit, we don't take deposits. We go raise money from large, sophisticated institutional investors and some retail investors. We're leveraged on average 1, maybe 1.5, maybe 2 to 1. Substantially less leverage than in the banking system. But at the end of the day, we're providing a loan structured product to a company. Whereas private equity, they will typically own the business, they control the business, they are driving the sort of growth and the strategy of those companies. So it's a very different strategy and role. It's much easier to enter into private credit right now than it is to private equity. It's a growing industry. I think it's if you're thinking about going to a bank and doing traditional lending or going to private credit, there's no comparison. You want to go the private credit angle.
What I love the analogy at the bottom. Private equity takes a driver's seat and private credit finances the car. I mean, it's really focused on downside protection, no loss, low loss ratios, returning capital through dividends, fees, and then ultimately getting repaid on your loan. And Mimi, Ken, your guys' power alleys here on the asset-based finance. Mimi, do you want to maybe walk us through just what that means and how Blue Owl approaches the market?
Yes. So I think the biggest difference between what direct lending does and what Ken and I have focused on in our careers is specifically looking at assets and underlying cash flows associated with those assets to underwrite risk. So when you think about a company and you think about their risk profile, you're looking at things like revenue and how much cash they're spending. In our seat, we're looking at how much cash is an asset producing. And so what an asset, quote unquote, is kind of throughout the consumer life cycle. So anything from the plane that you take, to the car that you drive, to the house that you live in, to the credit card that you swipe when you pay for groceries, that is all accumulated into larger pools of loans by originators or by companies that are originating those assets that can then be used as collateral to get not very cheap, but cheaper capital than if they were to go and raise corporate equity or do something of the like. And so that's what I focus on specifically. Is my team looks at companies that originate these loans, originate these assets, and underwrite specifically the performance of those assets. So we focus a lot on the consumer that's actually taking on those loans. So we look at things like credit scores and how much debt a consumer has and how big the pool is and the type of underwriting techniques that the originator is using. And so we can provide these companies with access to capital, either through financing them in a debt facility, physically purchasing those assets in larger pools of loans, or securing them and bringing them to the public capital markets.
Ken, why is Rhythm buying companies in this space?
Well, we like the space for a number of reasons. I'll just maybe tag on to what Mimi was discussing. We look at within the ABF area, one of the value adds that we can really bring to the table is bring essentially the sourcing models. So we control within our residential lending segment in particular, we're the third largest mortgage company in the country. It runs by a separate brand called NewRez. But we believe that by controlling the sourcing of the asset from the original application of a residential mortgage right through to the securitization, we can bring insights into that, both in terms of what we originate and ultimately what we package into a security and provide into the secondary market. So we look at it from being vertically integrated as being the best model to bring to the table. Blue Owl is also involved in this to probably a lesser degree. We happen to have a very large franchise in the residential mortgage space. We're basically trying to replicate that across a couple other different verticals. So we're doing that within the construction lending space. We've got a business called Genesis Capital, second largest construction lender in the country, effectively brings the same type of securitization and fund technology to that space, which has predominantly been a bank market product. So again, we're taking another essentially asset class out of the bank's portfolio. And the reason why we're growing it is we just see these businesses that have been effectively the banks have retrenched from these sectors, and we look at the opportunity to create that franchise for sourcing that ultimately goes through to the creation of an investment product and is put into either a fund or in my particular case where it's actually held in our portfolio and held by public market investors. So the direct lending space, what Peter had talked to in terms of the middle market lending space has been, you've seen banks that were active in it, business development companies have become more active now. Effectively, the private capital markets are very much involved in this sector. And we look at that and say, okay, you want to control sourcing because you've got a better end product that can be sold into the investment community. So that's really when we've been put our dollars to work, is effectively kind of, if you will, rolling up the sourcing model within the front end of that food chain.
So Dominic, wealth management, family office, allocating to these strategies? Like, what's the attraction? What do you guys consider? Like, why do you invest in one of these asset classes, and how do you pick a
Yeah. Yep. The biggest reason we have private credit allocations in the portfolios, if our clients need income to generate, income off their portfolio, because typically private credit, because these are levered companies that, need the financing, you're taking on credit risk, and they're floating rate in nature. And that's a great way to hedge against interest rates. So similar to the public markets, that also offers that. But we find that the private credit managers, if you find the right ones, from a risk standpoint, it's actually better than being in the public markets, particularly with these teams like Blue Owl and the likes that have great credit research teams. And so that's really why we like it. And it's a great strategy, again, for yield. We also do something else for our clients that I don't want to get too much in the weeds on, but we do something called private placement life insurance, which private credit is a great strategy for that, because all the income that's being generated off these portfolios is ordinary income on your tax return. And if you can do it in a private placement life insurance where the insurance wrapper is actually the investor on behalf of the client, that income can compound tax-free. So we use it. It's a tax inefficient asset from a personal investment standpoint, but there's ways to use private credit in things like these insurance wrappers. So that's a big part of what we do in the private credit space as well.
This is, we talked about the different segments of this private credit and alternative space. These are some of the bigger platforms within the space in pure private credit. And there will be a theme that a lot of these names cross over, but Blackstone, KKR, Apollo, Carlyle, who are, traditional big LBO shops, are way more, multi-asset managers. Private equity is a much smaller percentage of assets of all four of those big four traditional private equity firms. They're huge private credit managers. You've got Blue Owl, HPS, BlackRock, which I've worked with for the past 5 years, Ares, Oaktree, Sixth Street, and Goldman Sachs is huge in the private credit space as well. Real estate, similar names, but you've got new entrants, new names on this list like Brookfield, Starwood. Rhythm is a meaningful player in the real estate space. The infrastructure space, a lot of same names. BlackRock, they bought GIP, which is a huge digital infrastructure player. Blue Owl, which I mentioned at the beginning, did this JV with Meta, this $30 billion AI data center JV, in a pretty unique structure that I think will be more and more common as we go down the road. Brookfield again. Then you have KKR, Macquarie, who's a huge infrastructure player around the world. Digital Bridge, which is all about digital infrastructure, took a traditional private equity business and a real estate business and turned it into a digital private equity infrastructure player. Stonepeak, again, Blackstone, and then Morgan Stanley has a big business here. And the asset-based guys, so a lot of the same names: Blackstone, KKR, Apollo, Blue Owl, Ares, Sixth Street, Fortress, Marathon, Brookfield, and Rhythm. So those are some of the bigger players in this space. And love for Joe to talk about, what do you think the future of the, really in the private credit space is, and what are the themes we're looking at?
Well, the regulatory dynamics are not changing as far as pushing this type lending activity out of the bank. So it's going to continue to grow. What's interesting is, though, it's had this rapid growth rate over many years now. We haven't had a sort of a global reset with some rising default rates yet. A lot of people are forecasting that's sooner in time versus farther in time. That will reshape the private credit growth and landscape when that does happen, just like in 2009 when the Great Recession reshaped the banking industry. The big players that were just mentioned, they're fine. They're all going to be fine. They're not going anywhere. It's the smaller players, sort of people like us, right? The sort of sub $10 billion AUM players that you really have got to watch. We've been around 27 years and we've been through many cycles, but there are many new entrants into private credit that haven't been around through many cycles. They've been on a linear trend of low default rates and a growing economy for many years. Well, that will reset at some point in time. And when that does reset, it will shake out a lot of the different private credit players, not the big players, but the medium and smaller players. Some will not be around. But it's a great industry. It's a growing industry, and it's a good industry to enter into out of college.
Then the wealth management channel is becoming more and more important. Blue Owl just did a interval fund. Dominic, like where do you see the retail and wealth management channel investing? How are they going to invest in this going forward, and the public side of this?
Yeah, I think that's right. I think, there's always, why don't only the family offices and the ultra high net worth community get access to the best investments? That's an ongoing discussion on a lot of forums and in the industry and in the regulatory environment. So there is the emergence of more interval funds and more retail products coming to the marketplace. And I think the big firms are ahead of that already now and trying to get more exposure and building out their sales efforts to market that to the more retail community. I do think when you start sort of opening it up for the masses, the potential for problems and, some of the things that we were just mentioning could, disrupt the market. That while it provides more liquidity, it also potentially provides the opportunity for people to lower their lending standards. So there's enough capital to put to work. So hopefully it grows at a measured pace where we don't cause us another problem. But there's absolutely, yes, the emergence of retail funds in this space being happening. There's also publicly traded BDCs, which are extraordinarily volatile. They've been all over the place this year in terms of, the market. I have a lot of clients calling and asking about them right now because they're trading at such discounts. Is this a time to buy? We're not there yet just because of the volatility it introduces. And I think there's other ways to skin a cat. But yeah, I think there's a lot going on in the space. And we've heard about the blow-ups out there that's going to happen eventually, but we haven't seen it. And we think overall the economy is pretty healthy. I think this government shutdown is starting to get a little bit more interesting in terms of hurting our economy. So better get our act together on that pretty soon. I think everyone was digesting that okay in terms of the economy, but now if we're shutting down 10% of flights a day, it's going to be a problem. I fly almost every couple of weeks. But anyway, overall, the point there is that the economy is pretty sound. Interest rates are starting to come down a bit. It'll be interesting to see if the Fed cuts rates in December. But for the most part, what I'm really trying to say here is that this is still a pretty good environment for risk assets.
And can Rhythm Public Company, consolidator of private market businesses, is the play Rhythm stock? Is that for an equity investor to get exposure to these industries? It's different than traded BDCs or interval funds.
It certainly is. I have a lot to say about the last topic, but catch me at the happy hour because I'll do it better over a beer. When you look at, so our business is basically built around public markets, and by virtue of that, if you invest in our common stock, you're basically getting exposure to our entire portfolio. And in today's valuation, it's frankly at a discount. I won't give you the advertisement for it, but we think we've got a very compelling value proposition in terms of how we're growing and what that's going to do for the stock price over time. But ultimately, what's going to be driving that is not only the investment with the balance sheet, which, as I mentioned, is significant in size, $45 billion, but really more on the growth in the fund side of the business, which is essentially raising capital from people, from funds or from groups like Dominic's and from Joe's, which are going to be into specific investment verticals. And really, from that standpoint, we have been very focused on delivering performance, and we think that's going to grow the AUM within the various funds that we're managing, and ultimately it's will drive our earnings model, and ultimately will drive our stock price. So we look at the business as being a very big growth opportunity for us, and we're growing. We talked in various of these conversations today about what students should do to get active in the space. We've got an internship program. We start for sophomores. We have one for juniors. They're extremely competitive, but you have to get involved and you got to get involved early. So if you want to be in the private capital space, it's no different than 10 years ago if you wanted to be involved in investment banking. You've got to really kind of put on essentially your game face and kind of get involved with the firms early on. You got to show them the hard skills. You got to show them the soft skills and get involved as early as you can.
So Mimi, getting into this industry, you're the earliest in your career cycle. What would you recommend students in this room to do if they were interested in getting into private credit, alternate investments, private equity, any of these firms, since you've lived this the most recently?
I think what everybody has said over the course of the last few hours has been super true. Relationships, reaching out to people, raising your hand. Nobody's going to give you something that you don't ask for. I didn't know what I wanted to do. I knew that I had a few months to decide because I was recruiting for investment banking, sales and trading. So I knew I had to make a decision. So I think I talked to probably like 100 people, outreach to anybody I knew, made a spreadsheet of all my neighbors, what their jobs were, who I could call, who they would know. And I ended up talking to people who were super senior, who were a few years into their career. And I wasn't calling them to ask for a job. I was calling them to learn about what they were doing. And I came with a purpose that was trying to figure out what they did, what skills they had developed. If I wanted to be in that role, what would it take for me to get there? And really focused in on what skills I wanted to build, what type of company I wanted to work at, how I wanted to feel when I went to work, and then what I wanted to do in the next few years and how I could get there. So I think it's reaching out to people, be okay with having some uncomfortable conversations. There's plenty of cold calls or emails or interactions I had where I left feeling like, oh, like I don't like that. And every time you have one of those, it teaches you what you like and what you don't like. And so don't be afraid to be uncomfortable. Don't be afraid to be rejected. I think, and building your relationships also, I think everybody here has talked about building mentorship and sponsorship and having somebody mentor mentee, but also the people around you in your network at school, in your network at your internships. Everybody I've interned with over the course of however many years, like the last 8 years, or I've worked with side by side, has come up again in my very short time. And I know that in the next few years, they're going to start to be the people that are making decisions at these companies. They're going to work for portfolio companies. They're going to work for competitors. And it exponentially grows your relationships. So my long-winded answer is people.
Joe, 27 years of hiring people into your firm. Like, what are the things that stand out to you as the, people earlier in their career coming into your firm and impressing you and getting a job offer?
Well, everyone's going to have the skills. It's really the soft skills, the interpersonal skills. I mean, is it someone you want to go have lunch with? Can you talk about something that's not finance? But that's really what makes a difference. Everyone's going to have the skills. Just as Mimi says, you got to keep networking and just meet with a lot of people. And then when you hit the interview, be prepared, but also show some of your personality, show what's different and unique about you, because everyone's going to have the skills. So, yeah, you want to sit down and have a cup of coffee, or like we're doing after this, have some cocktails. I mean, those are the type of people you want to, build your company with, and we'll get the jobs.
I can answer some of that. I won't give you the only answer, but if you walk through the tailgate section for a football game and you get to meet as many of those people that are around you, you may find that you are surrounded by a lot of people that have further connections that you will want to meet. So you can't be shy. You have to be borderline aggressive, but it's basically, you've got a collection of a lot of high power people at your doorstep every Saturday. So take advantage of it.
Well, it's also, I was at Brandon yesterday, did the business school tour. There's so many things going on with the investment club, the Wall Street Club. You got the launch pad here. I mean, Clemson is providing so many opportunities to network and meet not only students, but alumni and non-alumni, that this campus offers so much. Just participate.
Yeah, I think just showing up here, right? Like sitting through this, listening to war stories, learning a little about the industry, like participating in the cocktails, meet as many people as you can. I think, my college roommate is sitting right here on the stage, so we've known each other for just a couple of years, but have, both of us back here together and at this conference sort of like, embodies like the importance of, the network you build now will be your network through a lot of your career. You may not be obvious to you today, sitting next to one of your classmates, your fraternity brother, sorority sister, but like, I promise you later in life, these relationships you build here today will be the most important investment you make in your life. Okay, we're all done. Awesome.
All right.
Thank you.
All right, thanks for hanging in, y'all. And yeah, just to set up, we're just going to talk to some individual cool people who've been not necessarily participating in a panel yet today, but are part of this entire group that has been working on kind of this content layer of the Launchpad, just this capital allocators. And I would say, like, don't leave yet. There's some really cool stories you're about to hear. And again, there might be just some little spark that you hear over the next, 30 minutes or so. Little connection where you can come back and introduce yourself to one of these next couple of speakers afterwards. And, there's been a lot of questions about how we like sort of spark these relationships and where they lead to. And like, you've got a lot of good advice. And, you might hear something over the next little bit to spark that some more. So, all right, why don't you introduce, this is Tate, and he's got his own unique story. He's just going to kind of take us through it, and then I might jump in with some questions.
Hey, all. Thanks for coming. Tate Beasley. I am a double tiger. So I finished a master's in computer engineering here in 2014. And then I got my MBA here in 2020. Clemson has a special place in my heart. When I got to Clemson, I had no idea about private equity, venture capital, things like that. I worked as an engineer after getting my master's and worked in engineering for quite a while. And then just kind of noticed that there was a little bit of a disconnect in the companies I worked for. Some people could talk technology, some people could talk finance, but there was very few people that I met that could speak both sides of the aisle. So I started trying to really move my career into being able to do both, being the go-between between those people. And so my career kind of gradually went from engineering into more incubation. So I would help companies build up their product lines, their business lines, and then we would acquire them if that became profitable. And then I finally moved into just a pure venture role that was kind of unique in the sense that I worked for a nonprofit that allocated out capital into venture on behalf of a state. So it was the state of Virginia. And so being a quasi-governmental organization, it had its benefits and its drawbacks, but it really got me into and enjoying kind of the venture space. I got to see a lot of deals, do a lot more deals than the traditional VC associate gets to do, and then kind of now I've left that role and am working on my own fintech startup. So I kind of went the opposite way of it's kind of traditionally done. Most of the time, people become entrepreneurs, exit, and then find themselves in the VC space. So I've kind of went about this backwards. And please, if you have any questions, I'd like for this to be interactive. So, just shoot your hand up and happy to answer anything. I think a lot of people up here have kind of illustrated and spoke to your network is super important. There have been a lot smarter people than me pour into me throughout my entire career, and it has kind of guided my career to this point. I think that you all have a great opportunity with the resources, John, Kimberly, Brandon with the finance department. I think that you have some great resources that if you want and you're willing to, you can really take advantage of those and really kind of define the career that you want to have. And so, kind of a piece of advice I had got previously in my career is pick your hard. Yes, it is hard to go out and work a 9 to 5 job or work in investment banking and spend the long hours. It's also hard to be an entrepreneur. It's hard to, you know, so ultimately, what is it that kind of gets you out of bed in the morning? What is it that fires you up? What is your mission? What is a problem that you want to or you know, need to solve? And then go after that. It can be hard at times. It can be challenging, but ultimately, I think that that's if you are chasing something that satisfies you, you're going to have a lot more joy in what you do.
Well, you got 3 more minutes, so I think we should see. So you're doing a fintech startup, right?
Yes.
I think we should see if Tate can pitch us on his fintech startup off the top of your head. So give us a 2-minute pitch on your fintech startup.
Okay. So what I am working on is a privatized SBA lending company marketplace. So currently, right now, if you wanted to acquire a business, you know, $5 million or less, you would go into a bank or a lender and you would say, hey, this is what this business is worth. This is what I'll put down. And then these are my assets. Give me a loan and I'll buy that business. It is a pretty rigorous process. It's full of diligence and it can be very long. My marketplace allows you to go in, submit everything online. It values your business. It connects to a lender, and then it gives the lender the ability to lend out because my company guarantees them the principal on the loan. So it gives them value for the risk they're taking while also protecting you as a lender because you have 3 options to not default on the loan if something were to go awry with the business.
I was just gonna ask, how do you value the companies? I mean, obviously, it's probably not you doing it yourself. Do you use AI solutions to kind of supplement that, or do you have people who do this?
So it is a AI risk engine. So it takes in various different items. I can't really speak to it right now because I'm currently going through a patent process. So I can't go into specifics, but it takes in various different variables and makes a decision based on those variables.
What do we think? Should we invest in Tate's startup? Anybody? All right. Thanks, Tate. Next up, probably a familiar face, Greg Smith. Round of applause. All right, tell us your story, Greg.
I came to Clemson picking it out of a catalog from upstate New York. Was here, my first semester was the fall of '81. Saw my first Clemson football game and we won the national championship. So I'm just lucky. I studied mechanical engineering here, went to work in a manufacturing plant for 2 years after Clemson before going back to grad school. Studied international business, learned to speak German, went to work for an international industrial products company that sent me overseas a couple times with them. So that was kind of and then I came back to the States and worked in a business group in Atlanta. That was kind of the first 10 years of my career. And then the second 10 years I was in software, first working for a startup software company and then leaving to start, co-found a software company in Atlanta that was focused on automating the processing of mortgages, mainly driving paper out of that process so you could underwrite all electronically. And it was software as a service. It was at the beginning of that era. We were competing for bandwidth. You know, it was We had to be able to run the system on a dial-up modem. Some of you don't even know what that is. So, but that business grew rapidly. We owned it about 7 years. Xerox decided they wanted to own it. So we sold to them in the fall of 2007. I ran that business for them as a wholly owned subsidiary for 3.5 years. So that was my second 10 years operating in operations of a software business. And then after I left, I've really just been an angel investor, working with other startup companies, investing in them, helping the founders. And that era is now coming to a close. So I turned 63 on Sunday, and so I don't want to be in these deals another 10 or 15 years. So I'm slowing down. I'm slowing down that. In the COVID crisis, I started studying new technologies like blockchain. I've spent a lot of time studying that in crypto, and so I'm spending a lot of time in that now, which is just fits my lifestyle a little better, doesn't lock up my capital so long. And I teach here. I teach right here on Monday nights, class with John Hannon, the art and science of a startup. And so that's me.
All right, we're going to also put you on the spot a little bit. So as an angel investor, talk about what makes for a good pitch. Like, what would really get your attention? Well, not get your attention, but like you go into the first meeting and like, here's the entrepreneur with a deck. Like, what are you looking for?
I'm going to answer that question just a little bit differently. I'm going to answer the question, why? What does it take to get me to write a check? Is that fair?
Awesome.
Okay. So
what does it take you to write a check?
Thank you. I think the first thing is I have to be intellectually curious about the problem. Like, it has to be something that I understand and connect to the problem that this entrepreneur is wanting to solve. That's just gets me interested to spend time looking at it. And then I look at, does this individual or team seem to have the moxie and the will to go through what they're going to have to go through to have success with this potential startup. So that's the second thing. Finally, I have to look at in my mind and, write out on paper, can I see this generating a 10 to 20x multiple on my investment? Okay. You say 10 to 20x, you've heard 3 to 5 all day from venture and private equity. But this is the first money in a deal. This is the first money oftentimes in a deal. And oftentimes there's not much of a company to invest in. So you have to, more than half of these deals go to zero. So the winners have to win pretty big. And it doesn't mean you're going to get a 10 to 20x, but you have to see, in my mind, is it possible to get to 10, 15, even a 20x return? So all that, if there's a checkbox by all those things, I make the final decision on what I think about the CEO. Do I think the CEO is trustworthy? Do I think they have the ability to lead? How do I think they're going to respond and behave when the you-know-what hits the fan, as there will be times in any startup where you have near-death experiences. At least that's my experience. It's very abnormal if you don't have a few of those. So I have to feel really good about the CEO, and I write the check based on that.
Awesome. Any questions for Greg?
Thank you, Greg. My question is, a lot of times as an angel investor, you hear people talking about the difference of investing in ideas and investing in people that have the ideas, that actually have what it takes. You were talking about that a little bit, of liking the CEO and their vision. What % of your emphasis do you think like you're really placing on investing in a person versus investing in an idea? Because sometimes you hear about those ideas from the person translating into something else.
So if I understand the question, I can't separate them. I'm not going to invest in somebody that doesn't have an idea that I think is worthy of pursuit. But that being said, I think the emphasis is that idea is likely to change or at least pivot or morph over time somewhat. And so the majority of that decision is based on the individual leading the company. I also place emphasis on the team, but sometimes there's not much of a team yet.
Stan. Hey, yeah. So this is Adam Steinberg. So fire away.
All right. So Adam Steinberg graduated in 2006, degree in economics. Currently Chief Strategy Officer at PartnerStack, which is a leading B2B partner relationship management platform, 130 people, raised about 50 million in venture capital. My headline is multi-time founder, CEO, been part of companies that have raised hundreds of millions of dollars of venture capital, been through exits, been through wind downs, kind of seen it all at this point. So you can go to LinkedIn, you can see my resume. I'm going to give you the inside scoop on some things that I went through so that maybe it helps you make some decisions over the next few years. So I graduated Clemson in 2006, economics, had a pretty good GPA, did well in school, didn't know what I wanted to do, didn't really have any internships that were credible that did anything for me. So I had, 0 job offers, didn't know what I wanted to do. Kind of like the other panelists earlier, decided to apply for law school. So did the LSAT, studied for that, got into law school, went down to New Orleans for law school. My parents were super excited, very happy, on a great path. Got to law school, wrote that first check for $25K for the first semester, got into class, and then realized I've made a big mistake. This is not for me. Like, great school, really interesting stuff, but this is not for me. And so if we rewind, I've been an entrepreneur all my life. So I started my first business when I was 5 years old. It was a recycling business, paid for my first car with that money. And then I kind of ignored that passion, in Clemson, I studied, got really into economics, loved that, but didn't want to be an academic. And then realized I didn't want to be a lawyer. And then, in 06, 07, if you realize Facebook, Twitter, those things started to become real. And I saw a model where there were people my age that were raising real venture capital, running real businesses, and doing this thing that was just like an adventure. It's like, oh my gosh, this is amazing. So I had a friend in upstate New York. I was in New Orleans. She was in upstate New York. She was an engineer. We were like, let's start a business. Let's do this. And so I dropped out of law school, told my parents over Christmas holidays. My mom was a wreck. It was like, what are you doing with your life? I said, you know what? This is going to be an adventure. And if I don't do this, like, I'm going to regret it forever. So, pulled the plug there, got in my pickup truck, drove to upstate New York in January. Great time to go to upstate New York. Got an apartment, had like $300, had to get a job, realized like, okay, maybe I don't have the money to start a company, but luckily I was able to join like the one startup in Rochester, New York, which was building social media analytics software, and joined that, and that thing just took off. So I was doing everything for them. I was doing marketing, I was doing customer acquisition. We got into social media analytics at a great time. Tons of customers, brands, agencies bought our software to manage and measure their social media analytics. That was fun, kind of got that first taste. Said, okay, this has been great, but I got to get out of these winters. This is brutal. I can't be in Rochester for the rest of my life. So I came back down south, ended up going to Atlanta, which is closer to home, but has some technology there. Worked for another early stage company there that was also doing social media. Did all things marketing for them. That was a really interesting ride. They just done their Series A. That was about 30 people. About 18 months later, they wanted me to move into a different role. I was like, no, I'm not doing that. Like, what is this? So I said, I'm going to go start my own company. Forget this. I'm going to go start my own company. And I knew that there was an opportunity in social media, location-based marketing at the time. Foursquare, if you remember, that was coming out. There was Yelp, all these things coming out. So me and a friend, actually a buddy that went to Clemson that I grew up with, he moved to Atlanta. We raised $12,000. Started that company on $12,000. 2 months later, we had IHG as a customer, Dunkin' Donuts as a customer, Arby's was a customer using our technology to power analytics and campaigns for their kind of mobile social efforts. That thing took off faster than we realized, didn't know what to do with it. We had been partnering with another company in Atlanta called Silverpop. It was a $100 million marketing tech business. They invited us in. I had tacos with the CEO one night. He was like, you know what, I like what you're doing. What do you think about, us acquiring your business? I said, that sounds pretty good. So we sold that business. That was great, a great first win for us. They acquired the technology. We went and then ended up running emerging technology for that business. 500 people across the globe, learned a ton, worked with great people. We then sold that company 3 years later to IBM. That was a really interesting experience. IBM is like a country in itself, right? The scale of that business is incredible, but it's also a slow business, right? They've got a lot of assets, a lot to protect. I realized I was like, this is great, but this is not for me. It's like, I'm gonna go start another company. So left IBM, got into Y Combinator, which was awesome. Moved out to San Francisco for 3 or 4 months. Did YC, went through that whole program. Could tell you a million stories about that, but that was amazing. You know, pitch demo day. You know, Ashton Kutcher sitting here, Joe Montana sitting here. Like, that was an amazing experience. Came back to Atlanta. That business was a marketplace business. We ended up raising about $7 million for that business. Had a lot of ups and downs. Sold some technology to Avis Budget Group, Home Depot. But they kind of realized it wasn't working the way we wanted. And it had been a grind. It had been like 8 years. And so we made the really, really hard decision to like wind that business down. And that was so painful. But looking back on it, like, that is part of the entrepreneurial journey. And that's kind of what you sign up for sometimes. And we did a good job of winding it down gracefully and returning capital to investors where we could. But that's part of the adventure, you know? And then now I'm at Partner Stack. I met the founders, talk about network. I met the founders at Y Combinator. So 10 years later, they invited me to join their company. You know, we're on a great trajectory here, about to do some private equity probably. So it's been an amazing journey. But I think, you know, some things I'll leave you with are, like, it's okay not to have it all figured out. It's okay to bet on yourself and take that chance. It's okay to have an adventure. Like, I've always optimized for having an adventure and working with great people. Made some money along the way, lost some money along the way, but I think it's turned out pretty well. But you just got to figure it out. And then you do, though, like others have talked about, like, you got to show up. Like, you got to put the work in. Like, the first companies when I was younger, like, I lived in the office, like 10, 12, 14 hours a day, sometimes like overnight, over and over again. Like, you got to put in the time when you're young. The CEO is going to see that. Like, the other people are going to see it. They're going to know you're someone they can go to get stuff done. And that's going to get you off on a good start here. So there's some things I'll share. That's a bit of my story. It's been a lot of fun. Clemson's been a great place. I'm glad to be back here and glad to see this all happening. It's super exciting.
I think one thing I want to highlight with your story there, Adam, is that you know, one of the ways that you can get involved in the entrepreneurial and startup community is to go to work for a startup, right? You could be the 3rd or 9th or 12th employee. And in that situation, like when I was hiring at that level, when I was running a startup or one of the ones I did, I always said to myself, I need to find someone who's a 2-for-1 or a 3-for-1, meaning I'm hiring one person, but they're going to do 2 jobs, or I'm hiring one person and they're going to do 3 jobs. So the job description that they were hired under was hardly ever what they actually ended up doing. They ended up doing way, way more. And so those are the kind of people that thrive in a startup. But it sounds like you were that person. You were the 2-for-1, the 3-for-1. Is that right?
I'm still that person. So yeah, absolutely. I mean, look, if your first job, like, you are fighting to make a name for yourself, build a reputation, build a network. And so, like, you just got to show up. And, like, to be honest, like, I look at these 2 gentlemen here, like, they've got the ties on, they're asking questions. Like, you got to put in the work and be ready for that opportunity, because again, the CEO is going to see you. They're going to know that they can trust you and win something because they're like, hey, customer just called us. We're going to go pitch them on something. Like, jump in, let's go. Like, that's the opportunity you got to be ready to take advantage of.
My name is MC Pylon, and I'm the board chair of the John Belk Endowment, and I also run a family office in Charlotte. So I have a little different story, but I guess my connection to Clemson is I have 2 tigers here, and I've got a high school senior that wants to be a tiger, so that's how I was connected with this group. So I guess, my story starts 137 years ago. And William Henry Belk, at the age of 26, with no education, $500 loan, and $200 worth of dry goods, which is really just fabric to make clothes, started a retail company in Monroe, North Carolina. It was a very entrepreneurial idea back then, and practices. They took cash at point of sale. They had set prices, so there was no haggling. And it was a clean and organized store. So the next 130 years, he and his 2 sons expanded and franchised that business into 16 stores throughout the Southeast, over 300 stores by the time it was bought by a private equity company. So my first career was in retail, all things from like putting stuff in the stock room, to selling stuff on the floor, to buying, to private label, lots of different things in the retail sector. So our founder at the endowment, he died in 2007. And his will and left direction and strategic plan that had set up the endowment as a flow-through entity. And upon his death, it got the seed capital to fund the endowment. Now, here was the trick. He left 3 instructions: to fund education in North Carolina and have an entrepreneurial thread running throughout the whole thing. We were like, okay. So we looked at his life. He was CEO of a company for 50 years. He was a 4-term mayor of the city of Charlotte. And so the common theme was he was always building, growing, sourcing, and hiring for a workforce, whether it was with a company or the city of Charlotte. And the jobs were diverse in geographic location, in education backgrounds, and all things. But they were all needed and they all worked together. So in 2012, Charlotte hosted the DNC that had an education panel that featured Jamie Marasotis, who runs the Lumina Foundation, that helps states create college attainment goals. And then Tony Carlovati from Georgetown's Education and Workforce Policy Shop gave North Carolina's data on college attainment rates for our 100 counties. So I was like, those are our people, that makes sense. And then former Lieutenant Governor of Colorado talked about Colorado having this statewide goal that linked the education pipeline to build the workforce for the state of Colorado. So after that, I was like, dude, that's gonna be our model. So I kept going and finding these conferences and learning how these states had done it. North Carolina was one of 5 states that was not in this conversation. And so finally, Margaret Spellings came to North Carolina to run the UNC system. So I asked her if she could help us run this in North Carolina. So first of all, what we did is we did a huge data analysis, a deeper dive into college attainment. And so what that told us was where our population was and who was falling through the education pipeline. So in our state, we have 112,000 high school seniors that graduate every year. And we have 2 million adults that have some college, no degree. So we kind of focused on those 2 areas. Our mission at the endowment is to transform post-secondary education to meet our state's evolving workforce needs. So we helped do all these in different streams. So again, as I said, we started this with a notebook, a pen, 100% illiquid portfolio, and $3 million. And so we knew that the company would sell at some point. We had no idea it would be so quickly. So in 2016, when the private equity company bought us, that funded the endowment. So we were able to start giving away about $2 million a year. We were really lucky because we had had all this time to pull our data together and to think strategically about what we wanted to fund. With the high school students, we wanted to be really specific, and we've helped our state agency kind of think about FAFSA goals in all the high schools in North Carolina and getting them to think more like a salesperson and helping our talented young people access these dollars because a lot of colleges routes are so unaffordable. The piece that we help the state agency with is called NextNC, which when you couple that with FAFSA, you really have the opportunity to have college for free across the state. We also helped our state with bipartisan support set a goal to educate 2 million people by 2030 that would help us build our workforce. We hired a guy out of Tennessee to help us build this kind of initiative that we started from scratch called NC Reconnect. And so it was really cool. We partnered with this company to use, it's kind of like geofencing. They pull community college data on adults that have started but have dropped out. They send them text messages, come back, and here are dollars that the state has. And then it's funded. Well, we had this idea. We're now in 32 community colleges out of 58. And every single campus has had a 5% or an 8% ROI. And so it's been super cool. But in starting an endowment, I had no idea what philanthropy was. I had to look that up. But it generates and has rules and vendors just like a for-profit company. And so, and there's so many jobs in the endowment, and you get to do really neat things. Policy, we start things. We like to fund big things and over a long period of time. But it's very unique.
Awesome. And well, I think what this really shines a light on with your experience is that, like, you've heard some very, I would say, traditional ways to get into sort of private capital. But this is a way, and I don't know if you heard this, lots of jobs available in this type of situation. So very cool. Thank you.
So I'm almost the last person standing between you all and the networking opportunity, which I think is very important, very critical part of today's programming. So I encourage you to stick around for that. But I'll try to keep this as brief as I can while telling a pretty unorthodox story about my professional journey, okay, which started at Clemson as an undergrad. So I'm a double tiger, graduated in 2007 with a degree in economics, and then went back through the MBA program in 2019, graduated in 2021. So 2 degrees through the business school here. I've also taught entrepreneurship at Clemson, right? And I see some former students. See Zach back there. Good to see you. So my involvement in this ecosystem has been long-standing, long-running, because I got interested in venture as an undergrad, okay? I got bit by the startup bug. And it was in finance class. We were analyzing the stock price of Walmart on a Tuesday. And there was this little blurb in the textbook about the founding story, the origin story of the company. And I was far more interested in that. So I was, had this gravitational pull of the genesis story, right? How did this thing get started, right? And I started thinking, the founding, plenty of Walmart shareholders have made a lot of money in the stock, but not as much as the Walton family, like the founding family. How do I find opportunities at that stage? How do we get in at the ground floor, right? So that curiosity, right? Curiosity and interest, right? And initiative was what started me down the journey. So I uncovered this whole world of Silicon Valley and startups and angel investing and venture capital and early stage private equity, okay? And incubation. There was very little, if any, of that happening in the Clemson, immediate Clemson orbit back then. So I was hooked, right? And so I had a problem. I knew I wanted to be a venture capitalist, but there were some problems with that. I had no connections to the VC industry or high finance at all. My dad's a forester, my mom's a PE teacher. We were not a high finance household. So I had no connections to industry, no connections to Wall Street, no connections to PE, nothing like that. So I just had to self-educate, right, and will this career into existence. And I did that with a unique strategy. I made it my mission to be the dumbest guy in the room at every meeting, every conference, every event like this that I could go to, okay? I made a complete idiot of myself in rooms that I had no business being in, learning the tricks of the trade and learning who the players are at the table of the game, right? And so, and some of the people in this room can attest to that. Matt was definitely the dumbest guy in the room back then. So, but that can be a really powerful strategy because you're constantly learning, you're absorbing, you're like a sponge, and you're meeting the people who can change your life, change the world, help you change the world. So I was just, I embedded myself in that world. Met as many people as I could, went to as many events as I could, talked to as many people that I could find that had experience in angel or venture, and acquired enough knowledge to be dangerous enough to start my own little investment group. All right. So, and I'll fast forward to try to make this, try to shorten this up, but I also had to have a real job during that process. So I got recruited out of Clemson, TIAA, large financial services firm in Charlotte. So that was my first job. So I had a real job, a 9 to 5, clocking in, right, doing the professional white collar thing, but I never abandoned this dream of being a VC. So all during my early career in my 20s, while I was going in 9 to 5, I was also building Johnson Venture Partners, okay, which was an investment group. It started out much like an angel group. We were just we did one-off deals, right, investing in whatever deal flow we could generate, learning the ropes. That's how I learned how to do this. Eventually, we had some success, right? Our portfolio grew, our assets grew, right? The number of people that were involved in our group grew, okay? We had an early exit, that helped. And eventually, in 2015, I was able to convert this little investment group to a traditional VC fund firm, right? And quit my full-time job to do that full-time. So that was a long process, right? Like a 10-year, 12-year process, okay? So that's a very atypical, unorthodox path into venture. A 25-year-old starting his own VC firm, okay? But I was able to acquire enough knowledge and resources to be dangerous enough to convince enough crazy friends and family members to start backing these deals. Some of my fraternity brothers' parents were my earliest investors. My girlfriend at the time, now wife, her father signed on a $50,000, line of credit for operating expenses for our little group. So, I just cobbled the resources together that I needed to make it work. And it's been a wild ride. The fund is a $10 million fund. I'm actually launching a second fund, also $10 million, so small micro funds, but filling a very critical part of the capital stack, right? That early seed money, pre-seed money that's been, hard to come by in this geography. So I guess most interestingly for you guys, the new fund is called Fund That Tiger. So we're investing in Clemson-focused startups, Clemson founder-led startups, student and alumni companies, right? So it's a very exciting initiative. My partner, Joe, is here. We're fundraising for Fund That Tiger, and we're going to start deploying capital into the best and brightest, the most promising startups coming out of this ecosystem, okay? Students and alumni. So I guess to leave you with 2 words, curiosity and initiative. I became very curious about this thing that I knew nothing about, but that was enough of a spark, right, to change my entire career trajectory, entire life, all my professional goals and outcomes, because I had the curiosity and then took the initiative to just will it into existence. That's my story.
Make checks payable to?
That was a lot.
Thank you, Matt. I'll kind of land the plane here and then we'll hand it over to John just for some closing remarks. But I guess I just want to make some commentary here just to say, I hope you appreciate, I noticed amongst all the panelists and speakers and whatever, if you notice that they all had these weird, crazy journeys. I don't think any of us sat here when we were sophomores or juniors or even, just early graduates of Clemson that we'd end up where we are now. But it's easy to see in reverse how it all made sense. But at the time, we were just we don't know what we're going to do when we grow up. And but again, we were curious and we just sort of didn't quit and kept going. But you don't have to have it all figured out, I guess, is what I want you to understand there. And then yeah, it's sort of, I guess the last sort of almost close to that would say, we were all you one day. All of us, we probably misbehaved more than you did. It's just not documented on a phone because we didn't have, cameras in our hands all day long. But, we were you guys one day. And, you've seen heard a lot of success stories. You didn't hear a lot of the stories where we hit our head against the wall because those aren't as fun to tell in a group, but there were plenty of those too. But I hope in small part today, you're just a little bit inspired that, you can go from where you are now to maybe being up here one day because you can. All right, Peter?
Oh, absolutely. I think, the point of there is no sort of straight line. We're never going back to a straight line career world anyways. But I think what the Launchpad's all about of fueling entrepreneurship, whether you're a pure startup entrepreneur, you're a corporate entrepreneur, you have to have that mindset in today's world and going forward to succeed and kind of get through those obstacles that, normal people stop at. So it's how do you go through those obstacles at the right time, the right risk. So that's much harder to figure out. But that is the mission. And then we're incredibly happy that you all stayed with us this afternoon and let us impart some of our stories upon you, and hopefully inspire you all to careers in different ways. And I think Matt said something yesterday that sort of resonated with me. And Matt and I've been spending a number of years here at between Spiro and Launchpad. Like, the quality of the student at Clemson is incredible. You guys should never forget that. You guys have the right to be in the room. You have the right to win. So Clemson's done an amazing job with all of you.
Just a few words here, 1 minute or less. I want to bring up Maggie and Kimberly. Gianna, come on up here for a second. Who else is still here? Pammy back there? Sayana? I see Pammy. Come on, quick. I just want these people who do so much hard work for us. Is there anybody else I'm missing? I hope not. But come on up. Come on up. This is like the end of a play. They're going to take a collective bow together. Let's see it. There you go. 1, 2, 3. Okay. But we're grateful for them. They put a lot of hard work into this, make everything run so smoothly. I'm not positive. Thank you. Let's give them a round of applause on their way out. Yeah, for sure. I don't have exact faces, and I don't teach anymore, so I don't get exposed to as many students. But you've been here pretty much the whole day, haven't you? Since 11. Since 11. Who else has been here since 11? Okay. Who else? You? All right. Sign up on that piece of paper over there. We're going to give you a T-shirt for having been with us the whole day. And you guys, I was going to call you guys out. Somebody else did. But as far as showing up, that's a lot of it here. We have paper over there. So I think another thing that I would like to point out is, and there's multiple people in this room who have given substantial amounts of money to Clemson, but the long tail of the impact of an entrepreneur is truly evidenced in MC's presentation, right? A company that started 137 years ago is generously, right, without asking anything in return, giving to young people, to adult learners, to try to better their lives. So think about the long tail. And the founder of that company intended it probably in the back of their head, but to know that that's still going on is remarkable in my mind. I do want to talk for a minute about our recipe for success here at the Launchpad. And we have had a lot of success. We are winning. We've been winning for 8 years prior to this last 2 years, but we're winning. It's based on 3 things, basically. In our bowl, we put faith. And so we have a lot of faith and a lot of belief that things are going to work out, that we have sort of a providential divine hand on us of sorts. We work really hard. Kimberly and I were here till 10-something last night. She was back here at 7. I was in the parking lot at 7:30. Not to pat ourselves on the back, because Maggie is, doing emails Sunday nights and all kinds of stuff, Saturday mornings. But so we combine faith with work, and then really it is the Clemson family. And so it's Matt Given, who's been giving tirelessly, Greg Smith, Peter Markham, many others that just give and give and give. We just kind of start the snowball, and it rolls, and somewhat like a magnet, it picks up filings along the way. And so a guy named Kevin Mosley was also instrumental in conceptualizing this particular event. He was not able to be here this year, but I do have to put on the record, on the Zoom record, thank you, Kevin, for initiating this. And the great thing is, we saw multiple ones of them here, Adam. There's a next generation coming too, and Kevin's one of those people. So there's sort of this generation, generally speaking. There's the next generations, the Adams and the Kevins, and then there's this generation right out here. So we want to see, the stories from your successes 10, 15, 20 years from now. Okay, so this has been a great day on behalf of President Clements and Max Allen. As has been referenced, this is a dream come true. The Bible also says, do not despise small beginnings. This has not been small beginning. I mean, we don't know what's going to happen on any given symposium day, but I was physically putting more and more chairs out, you know, at 9:30 this morning. And well, I guess we start in the afternoon, but you know, this is going to be a great thing and it's going to help lots of you. So now, thanks to Joe Alala, who has sponsored our reception. We do have restrictions on certain things here at Clemson right now. So it's a modest reception, but most importantly, go up to people. You know, we have another saying here, actually, Matt. Well, actually, Wydick is a guy, Mark Wydick, out in San Francisco, but I think you've echoed this here. We have a philosophy here, open mouths get fed. There's a little picture of the mother bird and then one bird with its mouth open and then the rest with their mouth closed. Which one gets the food? Obviously the one with their open mouth. So be diplomatic, be professional, but talk to as many of these people as you can. So again, on behalf of President Clements and Max Allen, thank you so much. And go Tigers. We need to win tomorrow. We're winning here. They need to win over there, right? Thank you. All right. Thank you very much.